really fast. Like I'm going to go through stuff really fast. And if you need to rewatch it, that will be available for you. So if you look in the chat, you see me looking all over. I have multiple screens on. And so I'm looking at the chat. I'm looking at the Q&A. Please be really active in the chat and the Q&A, and makes it way more fun for us as speakers instead of speaking into a black box. And it makes it fun for you guys as well. Because then you can see that there are other like-minded people asking the same questions, interested in the same things that you are. So again, please use that chat. It's going to make it really fun for everyone. All right. And in the chat, Cynthia is on our team, Sugo Capital, and she'll be posting the agenda for today. It'll be posted in Pacific time. So every half hour, we have a different speaker with a different topic. So if you forget who's coming up next, just take a peek over in the chat and hi, Cynthia, and you'll be able to see the agenda for today. The agenda for today was also sent out via email, which I'm sure you guys all got because you clicked and joined this meeting. All right, so I will go ahead and pull up my screen and I'll get started. And let's see, there we go. Share my screen. And let's rock this. Okay. So what are we going to do today? So hopefully you're all in the right place because this is what we're going to do. We're going to help you plan your investment portfolio like the $100 million pros. So, people who have $100 million or over, even $10 million or over, they don't just throw darts at different investments, right? They have a plan. They have a certain allocation. So they have an allocation for real estate, an allocation for VC, an allocation for crypto. And so as you're building your wealth and you're looking to be a more confident investor, you're going to want to develop that for yourself. How you want to balance your portfolio based on your goals, become an expert in those areas, and then go ahead and execute. And so you don't need to be an expert in everything, but you need to know what you want in your portfolio. And either you need to become an expert or you need to find an expert and follow along with them. We're also going to talk a lot about taxes because taxes are really important. The less you pay in tax, the more you can invest and the more your wealth grows. So we're going to talk about how to reduce your taxes, things you can do this year, things you can do to even reduce your W-2 income taxes, your adjusted gross income. And we're really also going to talk about how to diversify your expertise. So if you're an experienced investor, or even a new investor, in the last 12 months, a lot has changed. So you might have been going along and investing according to a certain plan, and now all the parameters are different, right? All the assumptions you were working with to build your portfolio, a lot is different. So a lot of you have pivoted. We at Sugo Capital have pivoted a lot. And so we're going to talk about a breadth of investments today so that you can choose what you want to be an expert in. So you can pivot for longevity. If you're niched down in one or two types of investments, and then something happens in the world and those are no longer lucrative, what can you pivot into? We're really going to cover that today in the next 3 hours. We're going to cover a whole bunch of different kinds of investments so that you can see which one might fit your goals. All right, so a bit about me. Since you're all new to me, I am Sarah Sullivan. I am CEO and founder of Sugo Capital. And I'll tell you a bit about my journey in a second. But what Sugo Capital does is it connects investors to passive income opportunities. However, we do a ton of education. We do one of these every month with a bunch of educational webinars in between. So there's a ton of education that comes out from our team so that we curate a community of confident investors so that you can choose for yourself what's best for you in your lifestyle. So that's our mission. That's what we do. We own 26 apartment complexes, and that's about 650 million in assets in real estate. And that's all done as a community with the Sugo community of investors co-investing together. And then we also have an oil and gas fund that we are partnered on that adds to that AUM at over 800 million. I'm on the advisory board for 2 other investment firms as well. And that's really great for collaboration to, really learn the ins and outs of all different kinds of investments and bring it to people. So I'm going to start my talk and I'm going to call it, I always call my talks this, live your dream life, set financial goals and achieve them. And the reason I say that is because we're not here for the next 3 hours to make money, right? We don't care if our bank account doubles and it's a number on the screen that we look at. That's not why we're here. We're here to change our life. We're here to do something different with our time. So if you're investing for passive income, you want different luxuries every month. You want to, buy a yacht, go on more vacations, or you're investing for the long run. You want to be prepared for retirement. There's always a reason you're investing. There's a reason you're here. And so I really want you to focus on that reason and what in your life do you want to change? What is not working for you? And is that reason something financial? Is that a piece of information you need to learn so that you can execute differently with your finances and then execute your life differently? So I have this picture here because this is the moment I realized that I had met my dream life goals. So my goals were financial freedom, location freedom, and time freedom. Location freedom, if you follow me for a while, you'll see I travel a ton, I move around a lot. That's really important to me. And so in this moment, we were on a vacation and I wanted to stay longer. And I was like, oh man, why do we need to go home? Everyone's having so much fun. And my husband said, well, how much longer? And I realized we could, because we had planned our life. We'd been planning it for 3 years. We were really diligent about our investments and our investment portfolio. And we were able to extend our vacation as long as we wanted. It was only a few more days, but we had the time freedom, the location freedom. We had our laptops, we could work a little in the evening, and the financial freedom to do that. And so I want to encourage you all to think about what are your values so that as you see investments today over the next 3 hours, you can see what types of investments support those values, those goals for you, because everyone's goals are different, right? All right, so a little bit more about my journey, and I'll go quickly because I only have half an hour. Every speaker has half an hour. I grew up thinking that the best way to gain financial freedom, success, and live a luxurious life was to be a straight A student. So that's what I did in high school. And I went to UC San Diego and I got my degree in economics. And I was like, I'm going to go out and be rich and successful. And I was not. I was successful, but still living paycheck to paycheck. So I said, I know what I need to do. I need to go get more education. So I did. I went and got my master's. And I got my master's in business. And then I started climbing the corporate ladder, manager, senior manager, director. And I realized I'm just incrementally increasing my income, but I'm increasing my time I'm working. I'm trading time for money. I had little babies. I wanted to hang out with them, my kids, my life. I wanted to live it. And so I started looking at people out there in the world who were living the life that I wanted to live. And so that's different for everyone, right? And there was an overwhelming response when I interviewed people, when I asked people, how are you living this life? This is the life I want to live. And almost everyone said, I invest in real estate and in one way or another. So I started educating myself as much as possible 10 years ago around real estate, around investing. So I want to encourage you all, if you have not read the book, Rich Dad, Poor Dad, that is a great place to start. That was like the switch where it all started making sense to me. So I went to Rich Dad University. I took every course and coaching program they had. I also went to RE Mentor and took their coaching program and their education. And so what I'm going to share with you today is what I've learned over the last 10 years through my experience, through my numerous coaching packages, so that you don't have to pay the hundreds of thousands of dollars to sample, but you can take a look and find what might work for you, and then you can dive into that. I didn't have like an overall summary to begin with. I just would hear something and it was like, oh, that sounds cool. I could go make money doing that. I take the coaching program and no, not for me. Let me try something else. So I'm going to show a chart today, and we're going to go through a bunch of different kinds of investments today so that you can kind of get a snapshot before you take the time to do a deep dive and become an expert in an area. Okay. Like I said, this has been a 10-year journey. I started in single family home investing. These were my results in some of my first properties. I live in California. I was investing out of state. This is the before and after. You would prefer that the before was the trashy one and then the nice one is the after, and then you sell it for a profit. I bought a turnkey, the property management company. I didn't know how to do due diligence on them. They put in awful tenants. I lost a lot of money at the sale, but I didn't stop. And so I share this story to say, If you try a certain investment and it doesn't work for you, don't stop. There's going to be something that works for you. This may work for you if you live in a place where you can keep an eye on your single family home properties. The math doesn't make sense in California. The long distance didn't work for me. So I kept searching. Years later, I found syndications, which is what I focus on now, and funds and hedge funds. And then I switched and I started making 18 to 25% returns hand off. And I was like, this is way better for me. So I encourage you, if something didn't work, keep looking, keep looking, keep looking. And we're going to show you a lot of examples today. So a little bit more about how Sugo Capital started is when I was investing in those syndications, the apartment buildings, the hotels, people were asking me, hey, how can I do the same? And so I started telling people who were in my sphere, And this is an example of someone in my sphere, my one-on-one sphere, who is living in California, invested in Texas. This is someone else living in Colorado, invested in North Carolina, totally hands-off. And so the more and more I started telling people about all these investment opportunities, the more people started asking and following me. And I said to myself, hey, imagine what kind of impact I could have if I wasn't limited to sharing this one-on-one with people in my life that I see face to face, right? And so that's when I started doing these events where we have hundreds of people join and attend and listen to the experts, because these are the types of things that changed my life. And so I want to bring this to folks and change more of other people's lives. All right, so let's dig in. What do the wealthy do? They earn more, they keep more, and they grow more. So a lot of us going the traditional route of having a W-2 job or being a small business owner, we hyper-focus on our income, right? We hyper-focus on earning more. And we're really good at earning money. We have great careers, or we're good at running our small business, and we're really focused on that revenue or that paycheck. But then we don't take the time to really think, how can we keep more of it? Otherwise, we're going to keep living month to month on those paychecks, right? So how do we keep more of it? That's tax strategy. You really want to become an expert in your area of investing and asset protection, right? And then how to grow more. And so that's the investment side, becoming a confident investor, growing the way that supports your vision and your goals. So when you're thinking about investing like the wealthy, like I said, always look at people who are where you want to go. So these three columns, they represent three sizes of investors. So the first one are folks with a net worth of less than $500,000. And so the green are traditional investments, and the orange are alternative investments. So they invest less of their net worth in alternative investments. And on the far right, the ultra rich, the 10 plus net worth, the $100 million family offices, they do 50% or more in alternative investments. And so that's how I have started balancing my portfolio. And I have some adjusting to do because I went too far over into alternative investments. So I need to bring it back and add some more traditional in there in order to balance my risk. But that's what we all need to do. And I'm going to show you a snapshot of my ratios as well. And the way I look at things to encourage you to take the same path and make adjustments based on what you learned today. So if you have a piece of paper and a pen, I want you to write this down. These are really important things. Why are you investing? Because that's going to help you as you look at the investments you hear about today, because everyone invests for a different reason, right? So are you investing for monthly cash flow? If so, put monthly in the chat. I want to see, because we're going to talk about so many different kinds of investments. Some have monthly cash flow, some have zero cash flow, right? So put in the chat monthly or monthly cash flow. If this is why you're investing, this is why you're here today, to learn about how you can get that monthly cash flow. If you are investing in order to reduce your taxes, in the chat, put taxes. Some investments we're going to talk about, they have zero effect on your taxes. Some investments can take a hefty cut to your taxes and really help. I should say deferral, not cut, but defer the taxes till later. So if that is your goal, that's why you're investing, that's what you're here to learn about, put taxes in the chat, please. If you are here because you are investing for the future, You're either investing for 20 years from now when you're retiring, so you're building up your net worth, building up that nest egg to live off of later. Or if you're building your legacy to pass on to your children. I was having a one-on-one consultation with an investor yesterday, and he was investing with money he was never going to use. He was very clear with himself that this amount of money he was investing with Sugo Capital is money he will never use and never touch. It was very clear it was for his 2 daughters. And so think about that. If that's the reason you're investing, you're going to make different choices than the person who's investing for cash flow, right? So if this is you, put in the chat wealth building. And probably all of you are thinking, well, I'm investing for all 3 of these things. And if so, think about what percent of your portfolio do you want to put in investments that provide monthly cash flow? And what percent of your investment portfolio do you want to put in projects that are for wealth building? That'll help you kind of decide, okay, I'll put 100 here, I'll put 900 over here, you know. And also when you're thinking about your goals, you know, like I said, I like to look at the uber wealthy and what do they do? So family offices, they all have different strategies, but they have these, what I'm going to put on the screen, these very similar goals. So a family office, they are a group of people that basically manage the money, assets, and lives of the uber wealthy. And so it's a done for you, you know, like if I had a family office, I would have my own asset protection attorney, my own CPA. They don't work for anyone else. They just work for me full time to make sure that I am maximized around these areas of life. So what do they look at when they're executing for their clients or their bosses? They look to adjust the exposure of the portfolio with uncorrelated asset classes. So what do I mean by that? So if you're in real estate, you might have felt the impact of the debt market changes, right? So not only have interest rates gone up, but the loan to value has gone down. It's made it more difficult to buy cash flowing properties with leverage. So when that happened to me last year, I thought, oh my gosh, I need to add something to my portfolio that is uncorrelated, where it may be also risky, but the risk is uncorrelated to the risk of the piece of my portfolio over here. So I had real estate, risk associated with that was debt, interest rates, that sort of thing. And so I put a chunk of money over in a fund that had no debt on it. Oil and gas, it was energy related, it was diversified, it had no debt. So its risk was uncorrelated to the risk of this bucket. So when you're investing, also think about the risks of the different asset classes. So not just like 20% here, 60% here, but the risk of these two, are they uncorrelated to each other? So like I said, unleveraged investments and leveraged investments, those will have uncorrelated, well, that's broadly speaking. There may be some correlated risks depending on what you choose, but really some big buckets are leveraged and unleveraged. Make sure you have both so that when it's when debt is amazingly cheap and easy to get, that you can increase your investments in that bucket. And then when debt is not cheap and easy, you can increase your bucket over here. You know, that's the longevity of being confident investors. And you also want to make sure, and family offices make sure that they have investments in there that benefit from volatility and volume. So for instance, I have apartment complexes. Those are not very volatile. As of late, they've become more volatile in that, they're a cycle of when prices are high and when prices are low. It used to be like a 10-year cycle, and then a 7-year cycle, then a 5-year cycle. Now we're seeing prices change even faster. But that is considered one of the lowest volatility investments, like a very peaceful and steady, low volatile investment. Now, when things are volatile, I'm going to increase my allocation into something where I can benefit from volatility. So like a scalping fund, if there's some stock or foreign exchange pairing that's really doing this all day long, how can I become part of something like a fund or my own trading so that I can take advantage of those micro trades that take advantage of that volatility and volume. So we have both, so that when things are calm, you can increase over here. When things are volatile, you can increase over here. You also want to think about, and family offices think about this heavily, assets that the government influences, because this is where your tax advantage is going to come in, the tax benefits of certain investments. So the government wants to incentivize you to invest in 3 things: food and agriculture, energy, oil and gas, and alternatives, and real estate. So they give tax benefits for those 3 types of investments. So I suggest becoming an expert in 1 or 2 of those so that you can get the tax advantage in order to keep more of your investment portfolio. And this is exactly what family offices do. All right. So I went to a 4-day wealth building conference this last weekend, and then I spoke at a wealth building mastermind on Monday as well. And what did we talk about? We talked about all these things I'm talking about right now. But this was one of the key takeaways for me. And so even if you get one aha, it's worth it, right? So this is the biggest aha I got, was that this chart, I know it's really busy, but it's family office portfolios that were balanced the same way. They had a 60-40 split in 2 different asset classes. And then some of them introduced Bitcoin. So not crypto, not anything that supports the crypto environment or mining, but actually Bitcoin. Those that allocated a certain percent to Bitcoin, it shows how their average returns changed and how their risk changed. So 3% is kind of the sweet spot, where at 3%, their cumulative return maximized for their risk reward ratio, basically maximized. So it increased their returns while reducing their risk. And so I said, oh my gosh, I need to go put some Bitcoin in my portfolio, and not just any time. You look at the halving, like when is it going to next half, which is going to be April 2024. And so watch the cycle. You can go look at the cycle. Now is a good time to buy, and then just hold it for the long run. I'm not a crypto expert. I'm not suggesting you do that with all crypto, but look at Bitcoin. It cycles, it's halving. This proof is, hey, if you want to just be something simple and add some Bitcoin in, 3% is about the magic number. So this is a really busy slide, right? You're now all on my email list. So Friday, Saturday, and Sunday, you're going to get an email from me each of those days. And on one of those days, I'm going to give you a recording that talks about this slide in depth, because it's really busy. I take about an hour to explain this slide, but this is basically what I encourage all of our investors. We have over 14,000 investors in the Sugo Capital community, and I encourage them all to do this. Take a look at everything we're going to talk about today and put it in the left-hand column, and then evaluate it side by side. So I have different metrics in each column: annual ROI, cash flow, level of effort, risk, cash needed to get started, hold period, tax benefit. Is there one? Yes or no? How much is it? How much do you need? Put this all on a spreadsheet for yourself, and then decide what you want to go into. So like I said, I've been studying investing like very seriously hardcore for the last 10 years. This is an example of some of the things that I have invested in or I've managed the investments for. And what's in red are the things that now Sugo Capital offers our investors. So we have leveraged commodities trading. We have a forex algorithm that trades. We have apartment syndications, which, if this sounds interesting to you to be a passive investor in apartment syndications, just stay tuned. There's additional education that'll come out to you on how the structure works. We have energy funds if you want to be diversified and have a really healthy tax benefit. So you can see on energy fund, if you look in all the way on the right-hand side, it says 75% W2. So we're invested in an energy fund. We've been investing in it for 2 years. And whatever you put in, you get a 75% depreciation and loss on your K1. I'll show you what that looks like and what that means. And then we have private real estate funds as well that provide tax benefits to investors. So some of you may be thinking, well, this is all great. I'm not sure how I can invest in this. I'm not sure where to find the money to really invest and grow my wealth. Because you might be thinking the only thing available is cash. Like, how much do I have in my savings account or my checking account? Is that all that's available? No, that's not that's not the limit of, what you can use to invest in everything I just had on the screen and everything we're going to talk about today. So what Sugo Capital has, and the other folks who are talking today, you can use your IRA and your 401k. You can use your retirement accounts. So you have to roll it into the type of account that is self-directed and allows you to invest. And we have a speaker, and she is going to speak specifically on this. How do you do this? How can you make this work for you, based on your goals and based on what you have as your resource? So we'll cover that in depth. You can also use an LLC, trust, nonprofit. So business owners, think about your LLCs and your structure, and talk to your CPA and see how maybe investing in oil and gas or investing in real estate using different structures of trust and LLCs can help you reduce your taxes, so that then you can increase the amount of money that you're going to invest. You can also 1031 exchange into a lot of our syndications. So just know that, throw it out there. If you have a property that you're selling, you're looking to move from active to passive, let's talk. Give me a call, send me an email, and we can see. The timing is really important on this one, but we can usually make it work for people. Another really common way to access money to invest is using arbitrage. So if you have a cash value life insurance, or you have lines of credit available to you, if you are very confident in the types of investments you're making, and you can borrow money and reinvest it at a higher rate than what you need to pay back, then you get to keep the arbitrage. So if this concept is interesting to you, on Sunday, you're going to get an email, and I'm going to go through 4 or 5 different examples with a spreadsheet with math, showing you when it's a good time or not a good time to enact or to implement this type of strategy. So again, I'm just touching on the surface here, because I have only a few more minutes before the next speaker, but I really encourage you to take a look at the emails you're going to get from me on Friday, Saturday, and Sunday, because those emails, they're going to really go in depth onto the topics I'm just touching on right now. Syndications. So who knows what a syndication is? And who, just say in the chat, syndication, I want to see. Okay. All right. So most people know. Okay, cool. So I won't dive into this, but if you don't know, great. Thanks for saying that you do not know. If you do not know, check your email on Friday. So I'm going to send you something that explains this chart. And this is just how I do it, but know that syndications can be a fund. It can be storage units, it can be mobile home parks, it can be medical retail centers. And basically, it's pooling people's money together in order to make a joint purchase. And so capital is sourced from passive investors, and then there's a management team that runs it. So investors don't have to be on the loan. They don't have to know who the tenants are. They don't have to manage the property management company. But the general partners or the managers of the investment do that. And so that's what we do at Sugo Capital. Me and my business partners, we're the owners, we're the managers. And then folks in the Sugo Capital community, they just put their money in. And for supplying around 30% of the capital to make the acquisitions or the purchases, their ownership, they get around 70% ownership of the properties, of the entities that are holding the properties. So that's how, this is the profit sharing that we do, and everyone does their profit sharing ratios a little bit differently. So you'll want to get to know those for each investment you're looking to do. But this is why it's so lucrative. Usually the profit sharing is in the investor's favor, and there's all kinds of things like preferred returns you can look at, waterfalls. If you want to learn more about that, again, just pay attention to the emails that come out over the next 5 days from me to you. And I'll go in and explain all these if it's a new concept to you. All right, so I'm going to show you one more thing before we get to the next speaker. So at the end of today, I want to give you some homework to go back with whoever you co-invest with. So if you co-invest with a business partner, if you co-invest with a spouse or a family member, I want you to do this chart for yourself. So take a look at all the asset classes that you invest in and what percent of your net worth is in that asset class. And then based on what you hear today, make some decisions if you need to adjust those ratios. So for instance, when I did this with my husband, I went, oh my gosh, we have 82% in multifamily real estate. That is way too, well, when we first did it, we were at like 90%. And I was like, that is way too focused in one area. So it's my niche, it's my area of expertise. I'm very confident in it. However, if it's no longer lucrative to invest in that asset class, what am I going to do? And so we started becoming experts in these other areas and allocating more and more of our net worth to these areas. It's also more liquid. They're uncorrelated risks. So take a look at what this looks like for yourself. I am still adjusting. And so I encourage you to take a look at yours and say, do you need to do some adjusting? And diversify into some of the investments you're going to see today on the screen. Okay. Actually, this is the last thing I'm going to say. Tax benefit. So I think everyone's going to touch on this today when they talk about their investments. Is there a tax benefit or not? If you are not familiar with investing in a private investment, when you do that, you get, this is the tax document you get. It's called a K-1, and the CPA will send it out to you, and you can see the highlighted part. It's in the bottom left-hand side. So this particular investment, this is my K-1 from a real estate fund that I invested in. I contributed $250,000, and then you can see that negative 219,458. So my ending capital account now says 30,000. It doesn't mean I lost that much money, but it means I took that much depreciation and loss and accounting loss. So it reduces the amount of real estate income I have in that year, that was 2022, so that I don't have to pay tax in 2022 on $219,000 worth of income. And if I don't have that much, I can defer it and I can use it in future years. So if you have a real estate portfolio and you're interested in this, stay tuned. It's very, very advantageous. So we have offerings for our clients, our investors, that gives you up to 90% depreciation and loss of your investment. Actually, if this is interesting to you and you want more information, put RE taxes in the chat. RE taxes in the chat. All right, here's another example of my investment in an energy fund. So again, this is my K-1, my tax document from last year, 2022. So this one, I put in $200,000, and you can see the negative 175. So what does that mean? This is even cooler in my mind. It's a higher risk investment, but I invested in my name. And so what I can do is take this against all my income, this loss against all my income. And again, it's just a paper loss. It's not an actual value loss of my investment. And so if I invest $200,000, I can deduct my adjusted gross income, my total taxable income for 2022 by $175,000. Now, pros and cons of this, I can't bank it and use it next year. It's a use it or lose it in this year type benefit, but you can take it against your W-2 income, your business income, if you have your LLC set up, depending on S Corp, all that kind of stuff. But if this is interesting to you, take these examples to your CPA, your strategist, your tax strategist, and see if this can be beneficial to you. Okay. Well, with that is my last slide. I will say, I'm going to stop sharing and invite the next person to come on screen. But I will say, if any of that was interesting to you, know that tomorrow you get the replay. Thursday, you get the replay of this event, so you can watch all the speakers again. And then Friday, Saturday, and Sunday, you're going to receive 3 educational emails from me. And we chunked it up so it could be digestible, but we're really going to go into planning your portfolio in those 3 emails that we're going to send out. And then at the end of it, there's going to be an invitation for a Q&A where you guys can speak to me, book a call with me if you want. So just keep an eye on that. And I'm looking forward to meeting you guys. Let's see who is up next. We have Heather Dreves. Heather, welcome. I'm going to make you co-host so you can turn on all your videos and share your screen, and welcome Heather. I'll give a brief introduction while she's getting set up. Heather and I have done numerous events together. Heather is an amazing educator, and her company, they have a great portfolio of offerings for folks, and a lot of our investors kind of swap back and forth between Secured Investment Corp and CEO Capital. And so, I hear firsthand investors that invest with her, and they always have great things to say. And so even though, I don't do due diligence on all of their investments and their offerings, what I can say is that I hear positive things from their investors. And those are the kind of speakers I bring back and back, and I love to share with all of you. So Heather, thanks for being here. I'm excited to hear what you have to share with this audience. They're very engaged. So so take it away. Thank you for being here.
Well, good morning. First, thank you for the opportunity. My feelings are the same as yours. I always enjoy co-hosting and attending each other's webinars, and you have been a great asset for quite a few of our clients that have been able to deploy capital through different offerings that you offer that we don't offer. And so I think we complement each other very well. So thank you for the opportunity to be here. And it looks like you have a great audience. Everybody seems very engaged. I have to fly out this afternoon, but I was hoping I could stay on as long as I can and listen to some of the other speakers.
Perfect. Well, yeah. Hand it over.
Okay.
Give you the stage and go ahead and share.
Absolutely.
Yeah.
Well, I didn't put together a PowerPoint or anything. I thought I would just spend this time telling a little bit about who Secured Investment Corp is, what we offer. And then, I always like to engage the audience. So if you guys have questions as we go along, I encourage everybody to put those into the chat section, and I'll do my best to address those. And then there'll be some opportunity to schedule some time with me to talk, after the event if they want additional questions answered or more information. But a little bit about myself. I've been with Secured Investment Corp for over 11 years now. It's hard to believe that, but actually been in this industry for 18. So that's kind of dating me a little bit, but kind of fell into it by chance. I had a friend that was in the private money industry, and quite honestly, did not know a thing about private money. I just assumed that when you wanted to buy real estate, you went to your banker. And when you wanted to invest money, you called your financial advisor. And that was really just what I had been taught by my parents, which isn't necessarily wrong. But my eyes were opened to this industry. There was this aha moment where I realized, that if people had the right deal, and, we focus around real estate and specifically residential real estate assets. So it's a nice complement to what Sugo does. But, I was taken back by the fact that if you had the right deal, you didn't necessarily have to go to your bank and go through the ringer to get funding for that there were passive investors that were looking to deploy capital outside of more of your traditional resources. And it was this perfect, relationship that people were marrying, right? Passive investors, which quite honestly, a lot of passive investors were also active real estate investors. And I love your buckets and your spreadsheets of, looking at where all of your assets are, because I don't think people do that enough. I think people just start investing and buying real estate, and they don't really look at the percentages of where they have capital deployed. So I love that. I'm going to use that. And so anyways, long story short, I was introduced to this industry probably almost 19 years ago. And it was fascinating. Since then, I've had the ability to become an active real estate investor. My husband and I own rentals. We fund notes. We have investments in the funds. I've told my kids, and I have young adult children, that it's great to have your day-to-day job, and it's important, but you also have to have multiple streams of income to create wealth, and really legacy wealth. I don't want myself or my kids to get to the end of their working years and have to start to deplete all of their savings that they've saved up their whole lives to live off of. Why not put your money to work for you? And so that's really the joy that I find, is being able to help our clients do that. I have a lot of clients that I've worked with for 18 years, and they live the kind of lifestyle that they had when they worked. And now they're letting their money work for them, and they're traveling, and they're spending time with their grandkids. And so that's what fills my bucket, right? Like I love being able to help clients do that. So a little bit about our company. I love that all of these operators kind of have their lanes, right? Some of us are really great at multifamily. Some of us are great at self-storage. Where we fit our niche is in the residential real estate space, and really specifically affordable housing. So for us, it's important to be able to provide affordable housing for people to live in. And then also be able to provide affordable housing as a real estate investment asset class. And we decided a long time ago when I came on board 11 years ago, we were not going to try to be the operator that did everything for everybody. And that's where I think Sarah and her team has been such a great addition to what we can offer is we don't do multifamily. We don't do self-storage. It's not our expertise, and we would rather align ourselves with people like Sugo. That's the expert at that. So our expertise is really the residential real estate market. And specifically affordable housing. And what I mean by that is the houses that we invest in and buy, and then the houses we also lend against are affordable houses, and they're under that FHA cap. And I just want to speak a little bit about that because a lot of people ask, well, why would you do that? I mean, they will look at some of the houses that we buy and say, ooh, I wouldn't live there, but we want, when we're investing in real estate, to have multiple exit strategies. We all know that the market is a moving target. It shifts constantly. And if we were so siloed to think that the only way that we could make money was maybe to fix and flip, we would not be a good operator, in my opinion. And so we like that affordable housing market space, specifically under the FHA cap. That way, if markets start to shift, and maybe we bought a house 12 months ago and it was our intention to potentially fix and flip it, and we see values declining, and like right now with interest rates rising, houses aren't selling as quickly. When we're under that FHA cap, we usually can at least keep cash flowing those types of properties and turn them into rentals, and vice versa. As interest rates start to cool off, let's say, I don't think they're necessarily going back to what they were 12 months ago, but the housing market will pick up and values are going to start to increase. And then we would potentially take those types of assets that maybe we rented this year and start to sell them. And so we want to have the ability as an operator to pivot quickly. We have a very good pulse on what is going on with our portfolio. We meet multiple times a week with our teams. And so we want to be able to make quick decisions. And I think that's a big benefit to deploying capital in a real estate fund, especially a privately managed real estate fund. We don't answer to board members. We make decisions effectively and quickly internally between the three of us fund managers and obviously our teams that support us. And we can make decisions quick as markets change quickly. So residential real estate is really our niche. We currently actually are managing 3 real estate funds, and this is something I'm pretty proud of. And I think you showed this on your spreadsheet of the different investments you have. Quite a few of these types of investments only allow accredited investors to invest. And we do have a fund for accredited investors, but we actually also have a real estate fund that is open to everybody. And that is not very common in this industry. It's extremely hard to get approved for. It is a lot of internal management and reporting to the Securities and Exchange. But we felt pretty passionate about it. We wanted the ability to help people that maybe were close to being accredited or just getting started, the opportunity to start to create wealth for themselves. So we actually have an accredited investor fund, which we call Fund 2. We have a Circle of Wealth Fund 3, which is open to everybody with a very small minimum of $1,000. And both of these, both of these funds functioned as what I would consider a debt fund and an acquisition fund. Excuse me. Debt fund meaning that we make money for the partners in the fund by lending that money out. We lend money to other real estate investors. So for example, Sarah potentially could find a great deal on a residential property that she's going to rehab, increase the value, throw a tenant in, and then she's going to rent it out and hold it long term. where we would fit into that equation is we would step in. We could potentially provide Sarah funding to buy the property and rehab the property. We're going to put a lien against the property. That's how we protect our fund and its members. And Sarah's going to pay us interest payments every month. And when Sarah gets done rehabbing that property and the value has now increased, Sarah's going to either refinance us or pay us off. We get our capital back and we go and originate another loan. So that's what a debt fund does. It essentially is making money by receiving interest payments and origination points, and it's protecting the fund and its assets by filing a lien against the property. We're stepping in as the bank. These are all short-term loans, 12 months on average. We like short-term debt because when markets start to shift, we don't have as much concern with values declining 30% in a 12-month period. We're not going to lend more than 65% of the value. And for just our really experienced people, we'll maybe go up to 70, but no more than 70%. So that is the debt component to our fund, both funds. The other part of our funds is what I would consider acquisition. So we will acquire properties. Now, the debt component to our fund, we are doing this nationwide. We lend all over the United States. The acquisition part of our funds is only local to our market. So we're actually located in a town called Coeur d'Alene, Idaho. The picture behind me is actually a view from our office. So we feel very spoiled that we live in a beautiful part of this country. But we only acquire properties in basically Coeur d'Alene, Idaho, up through Spokane, Washington. And we're very clear about that because it's the only way that you can control that. You have to have boots on the ground. We believe in being where you're investing in as far as acquisitions go. And we have a contracting crew on staff. We have a property management crew on staff. We have a servicing company on staff. So we keep everything very internal. We have a staff of about 120 people. And so that's the acquisition side of our funds. We will buy properties. Sometimes we sell them. Sometimes we rent them. We run a return on investment calculation, and whichever is greater and we feel like is a better risk for the fund with a higher return, that's what we're going to do with the acquisition. So that is essentially how our funds make money for our fund members. A lot of feedback I get from our fund members is that we have the ability to, and I love that you asked people if they were trying to invest for long-term or cash flow. That's something that we have conversations with our clients about from the very beginning, because if somebody's coming to us saying, hey, I need a 1031 exchange opportunity, that's not going to be something we can do. That's going to be something that Sugo Capital can help with. We just are very clear about the fact that that's not what we do. But where we fit in those boxes is our funds can create cash flow, so they pay out on a quarterly basis. The other really neat thing about our funds is I think I was looking at our investor database. We have about 70% of our members that invest with self-directed IRAs of some kind. And it's just a great wealth building tool. It's a tax deferment opportunity, especially if you're using a Roth. They're just so powerful. And I was excited to see that you have someone speaking about that today. So I want to listen. But the opportunity that I think is really big with those types of self-directed accounts, one of the challenges I hear from people is, hey, I'm invested in oil and this and that, and it's great because I get monthly payments, but I invested with my IRA, and now those earnings are sitting in my IRA, and I don't have enough because so-and-so's minimum investment is $100,000, and I got to save up capital to be able to deploy it. So essentially what happens sometimes is that capital sits there undeployed. Our funds have the ability to reinvest their earnings. So they can set it up from the very beginning, and they can say, hey, right now I don't need the cash flow. Just set that to reinvest. Every quarter they know this is how much my earnings were, and we will reinvest it. For those of you that have self-directed accounts, you know they like to have all their forms filled out. They love forms. We actually help our clients with that. So there's something called a fair market valuation form. So your IRA custodian is going to want to know what your account value is at the end of the year. We actually do that for our clients. And it's really a big deal, especially when you're reinvesting your earnings, because those dollars aren't flowing back and forth to your IRA. So You can set it up for growth mode. You can set it up for cash flow. People that are trying to replace income and live off their earnings, the funds are a nice opportunity for that. There is a little bit of tax benefit because we are holding some rentals. Always will that depreciation or any of those kind of tax benefits flow through to the members of the fund. It's not going to be as exciting and sexy as Sugo offers and energy and full disclosure, but there will always be that tax benefit flow through to the members. So they will have the ability to take advantage of that. But yeah, I mean, we get a lot of feedback that, people like the fact, and I think, Sarah, you mentioned this is a way for people to invest in real estate with physical assets backing that investment, but they're not getting a call in the middle of the night from a tenant saying that their toilet plugged, and they're not getting a call from a contractor saying, oh, I can't show up and paint it. We handle all of that, and we have a massive team that does that. It's a great way to get, high returns on your capital with very, very little headache. And the other thing I would want to just mention is our funds have a pretty short tie-up period in relation to most real estate funds. Ours is a 12-month tie-up period, which is pretty unheard of, and it really is, just simple. It's not a long-term play for us. Our goal isn't to sell all these in the end of 5 years, like a multifamily or a self-storage. So we have the ability to exit people out of the fund quicker than most. So they do have just a short 12-month tie-up period, which is a lot different than like most syndications. I think most syndications are 3 to 5 years typically.
Yeah, 3 to 5. And I want to jump in here because these are some really good distinctions that you're making. So audience, that chart that had 15 different kinds of investments, and I had a bunch of categories where I compared side by side. So those were some examples of ways you could compare, but those columns, how you're comparing your investments, should be based on what's important to you. So some of the things that Heather's saying, I don't have in that comparison chart, but add them. So like if liquidity is important to you, like you need access. So I did mention, look at the hold period. But if you need to have some flexibility, like, I don't know, maybe I need this money in 1 year or 3 years, then don't go into a syndication or a fund that has a lockup period of 7 years. Go into something liquid like secured investment corps investments, they're much more liquid. If you want to break down your portfolio, the minimum investments, that's very, very attractive, your minimum investments in your different funds, because you can become more diversified. Like you said, in your IRA, you can either jump in with some of the cash. You don't need to build it up to 100K to make one investment. So, the liquidity, cash flow, like make sure you understand what's important to you and put those in a side-by-side spreadsheet. So when you hear everything that Heather just said, if you didn't catch it all, listen to the replay and write them all down, because those could be things that are really important to you. And so you want to make sure you get into an investment that aligns with what's important to you and your goals.
Yeah, good points. And I mean, we take calls all the time and we'll start to talk to people. And after peeling back the layers of the onion, we realize that what they're looking for, either we don't offer or they don't even really understand what they're looking for. It's like, and I try to tell people, like, try to determine what you're trying to accomplish. Like you said, liquidity is a big one. We actually have one fund that has a 90-day liquidity call. So that is something that we just recently opened. We heard our clients. They said, we like your fund, but I need access to my capital quicker than 12 months. And, so we do now have a fund that has a 90-day call. So, again, I think to your point, Sarah, it's really important to know, even before you start vetting operators, like sit down with your spouse or your partner or your business partner and determine what you're trying to accomplish, what kind of dollars you're trying to deploy. That's another big one. If you are deploying IRA funds, it's probably not as important to be getting monthly and quarterly cash flow. It might be more important to get, the ability to reinvest your earnings, unless you're at an age where you have to take your required minimum distribution. So like Sarah said, I think it's really important to just have an idea of what you're trying to accomplish first, and then start to back into these deals. And It makes it easy. Otherwise, you get analysis paralysis. You're going to start calling every operator out there, and it's just, and I talk to these people and it's like, and they don't even, they don't even have a clear understanding of what they're looking for. The last thing I would add about our funds, and I'm going to answer a couple of questions because I know we're kind of running short on time. Our funds are fully audited by an outside auditing firm. That is a big deal these days in the fund management world.
Oh my gosh, there's so many people are sending me links. Did you see this Ponzi scheme?
I know. I get them every day.
Yeah.
And I think that's something that I would encourage people to ask. It doesn't mean that it's required or it's a bad thing that they don't do it. But if they don't have their funds audited by an outside auditing firm, not internally, I would start to ask more questions and I would start to ask for more information. Ours are audited by an outside auditing firm, and our funds are not REITs. They are privately managed real estate funds. They're similar in structure. There are some differences between our funds and a REIT. But again, they are privately managed real estate funds. We have an 11-year track record. We've always had positive returns. The other thing I would say is if you are in a position where you don't need cash flow right now, but maybe in 12 months you're planning on retiring and that's your whole goal is to start getting cash flow and have your money working for you. Just because you set up your account to reinvest to begin with doesn't mean it's set in stone. You could turn around in 30 days and say, hey, we decided we want the cash flow. You could even call me and say, hey, I want you to reinvest 50% of my earnings, and I want to have the other 50% of my earnings paid out. So just know that it's not set in stone. We just have to have enough time to let my accounting team know. So our fund 2 is our accredited investor fund. The minimum investment in that is $50,000, and then you can invest any dollars thereon after. We have people that literally call me and say, oh, I just got paid by so-and-so. I got $1,200. I want to put it in your fund, and we can do that. So $50,000 on the accredited investor fund. Target return on that is 10%. Our Circle of Wealth Fund 3 for our unaccredited investors is a $1,000 minimum. Now that has to be in $1,000 increments, and that has historically been hitting above 7%. So that's still a great return on that. And we have historical data that I can provide anybody that's interested. And then our new fund, which we call our Fixed Income Fund 5, that is a guaranteed 5%. With a 90-day call. You could invest today and call me next week and say, hey, I need access to my capital. And within 90 days, you'll have it. And we really created that, for the people that maybe had capital that was waiting for waiting for a deal with Sugo to come along that wasn't quite ready. They could at least keep their capital working for them. 5% still isn't anything to turn your nose up at, but then you can access it quick if you needed access to it to invest in something else or an emergency.
I think it's great too if you're looking to buy a home. So we have a lot of investors who are like, I have my down payment. It's not working, but I need it to.
I know.
I need it when I need it. I don't know if I need it in a year or in, next.
I've heard that a lot lately.
Yeah. And so I say, don't invest it with me because I can't get it back to you in time.
Yeah. So 5% and the minimum in that is $5,000. So we wanted it low so that, there was a low barrier of entry. Yeah. And like I said, once you do your capital call within 90 days, and it could be much quicker, but we give the fund 90 days and then we can exit you out of it.
Cool. Perfect. Well, I'm looking at the chat because I know you won't be here for the Q&A later. So I want to make sure we hit any questions.
Andrew had a good question that I saw. He asked about, I think, Andrew, he's asking about the debt component in our fund and the default.
Yeah.
And I think that's a really good question and probably is worth just spending a minute on. So what Andrew's asking is how many in your portfolio as a percentage what is your default rate of notes that don't pay? And, that is a moving target. I would say on average, it can be anywhere from 5 to 8%. But what you have to keep in mind, we consider default 30 days late. And what tends to happen is people, if they are having payment problems, they'll get to almost 30 days, because the challenge with 30-day lates is we won't lend to them again. So a lot of them are very motivated if they start to have problems. And also, just to kind of touch on, these clients are people we talk to almost daily. They're asking for draws. We're holding their rehab funds back. So we have this open line of communication with them. More often than not, if they're having a challenge, they're on the phone with us and we're like, hey, what's going on? Maybe their contractor took off on them. We have the ability to find them another contractor. I mean, we service 500 notes. I mean, this isn't like we have 100 notes that we're servicing. We have a massive database of contractors and borrowers and brokers. So most of the time, if they are open and they're talking to us, we can help them. So I would say 5 to 8%, and that's probably on the high side. But to be honest, right now, we're seeing some defaults. I mean, people are getting to the end of their term, houses aren't selling as quick as they thought they would. And so default could also be that they matured. They might still be making their payments, but technically, if they've matured past their 12 months, we want them to put an extension in place. If they don't, then we classify it as default. What I look closer at is foreclosure rates. How many houses do we actually foreclose on and take back? That's under 2%. It's very low. The thing with the deals that we originate, they have at least 30% equity in them. They don't typically just walk away from them. A lot of times they have their time, effort, and money into them. They have their down payments. They've been paying contractors. So a lot of times it's a matter of, hey, just get it on the market. If you can't finish it, let's get it sold. So I look at more of the foreclosure rate, like how many do we actually take back? It is very few, a lot of times. But to that point, if they get 45 days late and they're not calling us, we throw them in foreclosure. We have to start that foreclosure process because we have to protect the fund. And typically what happens, it can be 6 months, it could be 12 months to foreclose. A lot of times they'll cure the debt, pay it off, bring it current before we actually foreclose. So hopefully that answered that question.
Pretty thorough. Right. I think a good last question is for Fund 2, are the returns taxable as interest, dividend, or return of capital?
So that's a really good question. So they do get a K1 and it is reported as earnings. It is not a return of capital. So it's a little bit different than the syndications.
Mm-hmm. Perfect. All right. Well, Heather, thank you so much for being here.
Absolutely.
Always great to have you. And the way that our investors can diversify their portfolios is really awesome because they're complementary. Our investments are for different purposes, different goals, different situations in life. So it's always
absolutely. Thank you for having me. And I'm going to put my direct link to my personal calendar in the chat. So if anybody wants to connect, and this goes right to my calendar. So I'm not available the rest of the week because I'm going to an event. But there we go. I encourage anybody, if you have questions or just want to learn a little bit more about us, I'm always open to a phone conversation and would love to share a little bit more. But thank you again, Sarah, for having me. It's always a pleasure.
Yep. Thank you for being here, Heather.
Yeah.
All right. We'll see you next time.
All right. Take care.
Yep. Thank you. Up next, we have Carrie Cook. So you heard me and you heard Heather say, hey, you can use your self-directed IRA or your 401k to invest in our investments. So if you're like, really, that kind of piqued your interest, that's what Carrie's going to speak about next. Let me just change the view to, there we go. Focus on Carrie. So Carrie's company, Preferred Trust, white glove service for helping you invest in alternatives using your IRAs. So I'm very happy to have you here. This is a perfect event because everything that we're talking about, all the investments we've talked about thus far and for the rest of today are open to self-directed IRAs and 401ks. And so I'm sure you're going to get a lot of people interested in like, how do I do that then? What are the next steps? What are the rules and regulations around it? So I'm really glad you're here, Carrie. Thanks for being here.
Absolutely. All right, is it my turn? I'm taking it over?
Take it over, Carrie. Go for it.
Yay. Well, hi, everybody. It's so nice to virtually meet all of you. Hopefully I will have an opportunity to speak with you after this as well. Wow. Oh, I am not the sexy part of all of this. I'm not here to offer an investment, but what I am here to offer you is an opportunity to invest in all these alternatives in a tax-deferred or tax-free environment. And that is sexy. That is where the sex appeal starts to just skyrocket from preferred trust perspective. So I'm going to jump right into this. Maybe. Okay, here we go. All right, let's get all the boring stuff out of the way. First and foremost, just to give you an idea of preferred trust and when we were founded and that we're legitimate, that's all very important. We've heard a lot about compliance, and compliance doesn't just stop with the investment itself. It carries on into the custodian that you're actually working with. So please, please, please keep that in mind. You want to make sure that you're working with a custodian that has some track record, and that they're licensed and that they're regulated and that they're audited, all the things that you're going to hear throughout the day of the due diligence that you should be doing. We are a custodian and an administrator. That's very important to understand, because not only do we administer your accounts, but we hold custody of all of the assets. That's what keeps it protected under the tax codes for an IRA. So if you're only working with an administrator, I would caution you to make sure that the custody of your assets are actually held with a custodian that is licensed and regulated and examined and audited, and all of the things that really make it important to ensure that somebody is really watching your back. We have custody over $3.4 billion in alternative assets. So this is not our first rodeo. Let's get in a little bit further as far as who we are, our reputation, what we're about, why we're different. As far as our reputation, look us up. We pride ourselves in being the very best at what we do. And we are not the biggest, but I say we're the best. The biggest, it kind of creates a little number environment. And I want clients to know that they can call us anytime, talk to us about their investments that they're considering. I can assure you, of that 3.4 billion, I have heard of just about everything. Whether you're investing in a herd of cattle, or whether you're investing in any kind of real estate related, digital currency, precious metals, you name it, I can assure you I have probably seen it, but if I haven't, bring it on. Investment options are completely limitless, with a few exceptions, which we'll talk about in just a little while. So the reputation is very important, who you work with. The security measures behind it. Listen, I report to two people. I report to banking regulators and the IRS. It doesn't get any worse than that. I'm going to be real honest with you. It doesn't, but that's okay. You know, working under those extreme regulations is very good. That's the type of company you want to be working with. And then educational resources. You know, we are here to educate. My heart of hearts, I'm a mentor. I want to teach you everything there is to know about taking advantage of using an IRA in your alternative portfolio. So that's what we're here for. That's what we're all about. How we work. We empower you. We're here talking to you today because we want you to know that using a self-directed IRA is an option for you. I know many of us, when we're looking at different investments, we're also looking at what we have liquid. What do we have liquid and available in cash to invest? Or maybe it's a business and you're still looking at liquidity. What do I have that's available to invest to take advantage of these opportunities, to diversify our portfolio or create additional income? You know, we're here to educate and empower you by giving you the tools to help you understand what you can do, not only from the individual perspective, but also the business perspective, which is super important as well. We're here to guide and support. You have questions, ask us. Chances are we're going to know the answers to your questions, but if we don't, we'll elevate it up to the top. I mean, I'm here to answer questions for clients as well, but my staff is very well educated and cross-trained on every aspect of all these different types of investments that are available. We do take personal care and service with each one of our clients. So if you need an hour of our time, take the hour of the time. It's important to us that you understand exactly what you're doing. We are fast and we're efficient in processing. You know, it's funny. I tell the story all the time. The only reason why preferred trust exists is because in 2007, there were not custodians out there that understood that fast and efficient processing to investing in these alternatives is just as important as the compliance aspect itself. So if you have a deal that needs to close on Tuesday, the reality is it needs to close on Tuesday. You may have money hard on the deal that you're going to lose if it doesn't close on Tuesday. We will do everything within our power to make sure that we're able to hit your deadlines. It takes some effort on your part as well, but we'll do everything on our part. What is a self-directed IRA? A self-directed IRA is just that. The self-directed part is what everybody needs to understand. You as the individual are taking control of your retirement selection. So the stocks, bonds, the mutual funds, the mutual managers that are managing your 401k plan right now are paid top dollar to do so. It's all they do. So when you're looking to diversify your portfolio outside of the market and take advantage of alternatives, you need to understand those alternatives somewhat, or at least take the time to understand the people that are managing those alternative assets for you. A self-directed IRA puts you in the driver's seat. It makes you take those types of controls and run with them. Do your due diligence. Make sure that you're checking on the people that are behind these funds or behind the companies, the assets that you're investing in. You know, what's behind that? Does it make sense? The borrowers that you're working with. All of that needs to be taken into consideration when you turn to a self-directed IRA. Because now you are making those decisions, not the mutual fund managers. So what is the benefit of having a self-directed IRA? There's multiple benefits. I'm going to talk about just 4 of them. The most important is diversification. I think you're going to hear that word a lot throughout the day. Even like Heather talked about with her fund, you know, there's diversification even with the different types of funds, even within the fund. As you break all of those things down, that diversification is important, but also it's important to diversify in many different types of companies, many different types of asset classes, many different types of real estate asset classes. Diversification with a self-directed IRA gives you that opportunity. So I'm not here to say, move all your money out of the market, you know, the sky is falling. That's not what I'm here to tell you. What I'm here to tell you is the vast majority of Americans with over $14 trillion in qualified plans, half of that is now investing in alternatives. There's a reason. You go through a couple market cycles and you learn very quickly that you do need to take some control of your future. So that's what a self-directed IRA does for you. It gives you the diversification, the control that you need to make sure that your retirement account is secure outside of just being in the market. Tax advantages. Oh, I love taxes. I love reporting to the IRS. None of us like paying taxes. I mean, let's be honest. We do everything we possibly can to avoid paying as many taxes as possible, right? We do that through a variety of different strategies. Maybe it's the tax accountant you're working with. Maybe it's the type of investment you're investing in. Maybe oil and gas, you're all about it because, you know, the opportunity to write it off the first year, or the vast majority of the first year is something that's intriguing to you. Well, self-directed IRA will be intriguing to you as well. There's opportunity to earn income, capital gains that is tax deferred, or if you're smart about it and you're creative about it and you work within the IRS code, could potentially be tax-free in income and gains to you. Now I probably have your attention. How do we do this? First, we got to figure out what other advantages there are. Asset protection. We don't talk a whole lot about this, but in 2005, tax code was changed to protect traditional and Roth IRAs up to, and it's approximate, it's like 1.5 million, 12,000 something. So let's call it 1.5 million approximately, to protect against bankruptcy creditors. Now that's the compilation of both your traditional and your Roth accounts combined. But if it's in a SEP or a simple IRA, it falls under 401k codes and regulations, which is protected, 100% protected. So asset protection is something we don't talk a whole lot about with IRAs, but it does provide you some asset protection and is worth mentioning. And then the last thing, and one thing that, is I always say, I'm going to bounce my last check before I die. But here's the reality. We don't know when that's going to happen. So IRAs are a way to build for your benefactors. And I find myself at this stage in my life going, okay, there's only so much money you can possibly spend, right? So the reality is there's probably going to be some stuff left over for benefactors. So building for retirement is also generational, and it's something that we need to consider. And IRAs are a way to build generational wealth, and something that you should consider with your tax accountant or as you're putting your plan together. Consider IRAs in that option. Now let's look at all these alternatives that a self-directed IRA can invest in. Look at all these things on the screen. Like I said when I first started, whether it's a head of cattle or it's a real estate fund, or it's precious metals, or it's digital currency, or it's natural gas, or it's a startup company, virtually anything goes. Now, anything goes, but remember, you are the one that's in control of that. So you need to make sure that whom you invest with or in, you understand it. Check their track record. Figure out if they have experience in doing this. Is the investment strategy right for you? If you're 65 years old, getting into a fund that has a hold period of 7 years might not be the right option. Those are all things that you now are responsible for considering before you invest in it with the self-directed IRA. Understand what's going on in the market. Don't invest in a market you don't understand. If you don't understand it, do a ton of research. Risk mitigation is the most important part when you consider self-directed IRAs, because that risk mitigation is being conducted by you and the individuals that you're working with. And make sure you have an exit strategy. Nobody wants to be in an investment forever. They want to know that there is some level of exit available for them. Again, if you are 75 years old, you probably shouldn't be looking at a fund that has a 7-year minimum hold period, unless you're building generational wealth. So consider all the alternatives when you're working and partnering with an investment firm. And we're stuck. All right. Now, what can you not invest in? Carrie, you've told us all the sexy stuff about what we can invest in. What can we not? Here are the 3 things. I have 4 listed on the screen. I'll talk about the 4th. Life insurance policies are not allowed in a self-directed IRA. S Corp, right? It already has a tax advantage. You think the IRS wants you to get double tax advantage? No. And it's my job to make sure that that doesn't happen. Collectibles. I assure you, I would love to put my wine collection into my IRA. But because I can't hold custody of your wine collection or know if you drank your wine, collectibles are not allowed inside of your IRA. So that includes, wine, some coins, collectible coins, those types of things. Just call us, ask, we'll let you know what is or isn't. But that's a pretty short list. And the last one I put on the list is publicly traded investments. We are not a broker dealer. We specialize in alternative assets. Some people will say to me, Carrie, I don't want to have 2 IRAs at 2 different companies. Well, let's sit down and talk about an IRA LLC to allow you to have one account at one company where you can have both your public and your private holdings. It is possible. We just need to talk through it, make sure you really understand IRS rules and regulations before we allow you to do that. All right, couple rules of the road. Remember, I'm not sexy, but I'm going to provide you tax advantages. Self-dealing, disqualified individuals, indirect benefit rules, disqualified events. Investments. We just talked about those, right? Those are the 3. Investment related expenses. We're going to take this backwards. Investment related expenses. In an IRA, if you have a rental property, let me describe what the investment related expenses are. As a custodian, we charge administration fees, right? To administer your account. I don't make money My company makes no money on your investments. Now, if your investments were held at a Schwab or a TD Ameritrade, they're going to make money off your investments because they're selling you the suite of products that they offer. Therefore, your IRA is free. Now, when it's an alternative IRA and you have a rental property inside of it, the expenses associated with the rental property must be paid by the IRA. But the administration of your IRA does not have to be paid by the IRA. And you don't want to use those qualified funds to pay those fees, right? Save those qualified funds to invest with. So investment-related expenses, rules of the road. If the asset has an expense within the IRA, it must be paid by the IRA. Disqualified investments, we just talked about the three of them, right? Life insurance, S-Corp, and what's the last one? Anybody? Put it in the notes. Are you guys out there? All right, I'm going to wait for somebody to do that. I'm going to give you a free IRA if you do. The next one, indirect benefits. Let's say this rental property, let's keep with the flow here. This rental property has, let's say it's sitting on a beautiful beach somewhere in beautiful Southern California where the weather is always great. And you're getting ready to take a trip with your family. And you think, you know what? What's it going to hurt if I just use that rental for a week? Well, there's indirect benefit rules in your IRA. Remember, the government does not want you, the IRS, to take advantage twice. You're already getting an advantage by having it in your IRA and the income either being tax deferred or tax free. For you to rent that property for a week is an indirect benefit. It's a rule that you cannot cross. That disqualifies your IRA. So don't do it. Disqualified individuals. Disqualified individuals are those of where you came from, grandparents, to yourself and your spouse, to your descendants, your children. You want to make sure that you are not engaging in any practices in your IRA with those individuals. Let's take the rental property as an example. Your husband, your wife, your spouse, your partner cannot be the plumber. You're providing an additional benefit within the disqualified individuals to that rental property. Not allowed. Gosh, Carrie, all of these rules, stop with your rules. But these are rules. These are things that are important. This is why IRAs exist and companies like us exist, to make sure they're being governed on behalf of the IRS. So there's not multiple tax benefits being provided. I always say an IRA is the greatest gift that the government ever gave us, but they have a plethora of rules that we have to follow. We'll help you understand those rules and make sure that you do not disqualify your IRA. And self-dealing is pretty self-explanatory, right? Utilizing that IRA to your advantage by, buying a house and saying, I've got these funds that are available. No. Funds that are available for buying a house are related to the funds that you have outside the IRA to buy the house. The IRA is not buying the house. Do not self-deal inside of your IRA. Those are the rules of the road. There was a lot of them. Just call us, ask us. We'll answer any questions you have. Let's get to the fun stuff. Traditional, Roth, SEP, simple. Those are the types of IRAs. If somebody tells you that there is a real estate IRA out there, smoke and mirrors. Do not fall for those shenanigans. There are traditional, SEP, and simple are tax-deferred options inside of an IRA. A traditional and a Roth IRA have a maximum amount, which varies each year, cost of living, contributions of $6,500 a year with 50 or older, an additional $1,000. SEP IRAs are fun. They're exciting. If you own a business, we need to talk. SEP IRAs give you an opportunity to invest the lesser of 25% of your compensation as a small business. When I say small business, it's usually, husband, wife, one person, et cetera, or $66,000 a year in contributions. I didn't say 6, I said 66. That really starts to take an effect in the future. And simple IRAs are typically small businesses, 1 up to 100 employees, and it's 15,500 with a catch up associated with that with 50 or older. We tend to see most individuals in traditional Roth and SEPs. We don't see a lot of simples, but it is available. Obviously, the Roth IRA provides you the greatest potential. And here's why. Now, Roth IRAs have a rule associated with them. So if you're an individual out there and you are a high net worth individual or a high income earner, you're going to say, Carrie, I don't contribute to a Roth or a traditional or any IRA because it has no benefit to me. I'm here to tell you it absolutely does. If it's used in a way that adds tax benefit to you. So with a Roth IRA, there are rules that say, as an individual, if your modified adjusted gross income as an individual is $153,000 a year, now that's this year, it changes each year, obviously, but if that adjusted gross income is 153, you cannot contribute to a Roth. Why? Because you're a high income earner. What does the government love more than anything else is to take taxes from high income earners. They love it, right? Put us in the highest tax bracket you possibly can. And I'm sorry, Sarah, but bend us over and we are going to pay up the kazoo in taxes. That's the goal. That is the ultimate goal. Or if you're married, 223,000. So what if there was a way to remove that criteria out of the equation? There is. It's called a backdoor Roth. And here's the process. 100% legal, acceptable, follow the code. We do it all the time. This is a way that you can get your tax deferred, your traditional, your SEP, your simple that you've contributed to for years and years and years over into a Roth IRA that will allow you to have tax-free income and gains on your investments in the future. Here is how it is done. You're contributing to these traditional IRAs, SEPs, whatever it happens to be, tax-deferred options. As you're contributing to them and allowed to contribute to them as a high net income earner, you take those traditional and you open up a Roth IRA. There is nothing that precludes you from having a Roth IRA. Nothing. Zero. Everybody can open one. And trust me, there was a time in your life that you weren't making that kind of money unless you were a golden spoon or a trust fund baby or whatever it happens to be. We all were there at some point in our life. Open up that IRA. Open up that Roth IRA. So now we have 2 IRAs going. Now we're going to convert the traditional funds to a Roth IRA. Now, yes, it absolutely is a taxable event. I'm not going to sit here and say that you're not going to pay taxes on the funds you move from your traditional to your Roth. You 100% are today at your tax bracket. It's going to suck, but it sucks right now paying the tax bracket that you're in. But what if you didn't have to pay that anymore? So if you can take that leap and it's the right time and you've talked with your tax professional and they understand what your strategy is, which is I'm getting ready to invest in something that may have potential income or gain associated with it. So paying this 38% now is going to be far greater than what I'm going to be paying in the future. Because if you think that the tax bracket is going down anytime soon, you're kidding yourself, because it's not. So take advantage of that now. Find the right time to take advantage of that. That taxable event, you pay the taxes on it. Now, all of a sudden, you have your investments in a Roth IRA. Tax-free. It's unheard of. Good luck finding a whole lot of tax-free opportunities as a high net income earner. There's not very many of them. Here's the kicker, though. You got to wait 5 years to touch it. 5 years. So make sure it's the right time to deploy this strategy. Again, I'll take the example of the 75-year-old person. That's not the right time. That may not be the right time. But if you're 75 years old and you know you're going to live to 100, maybe it is. Talk with your tax professional, figure it out. If it's generational wealth, maybe it is important for you to have both. You need to sit down and really figure that out. I am not the person to talk to about what is the best interest of you, what is the best tax strategy for you. I'm here to tell you that the strategy exists and you can deploy it, and we're here to help. That's what we do. Tips for success. I'm going to end on this one. Understanding the rules and regulations. Now, I'm not expecting you to read the IRS codes. I'm not expecting that whatsoever. But I am expecting to provide you the education to bring you up to speed on the things you need to know based on the types of investment you're investing in. That is our job here at Preferred. So we will do that. You need to diversify wisely. You're going to hear it all the time. Take the time to make sure you diversify wisely. Maybe it all shouldn't be in real estate. Maybe it all shouldn't be in real estate in one state. Maybe it all shouldn't be in real estate with one borrower or one group or one entity. Take the time and invest wisely, diversify wisely. Invest in things you understand, right? We all own a home. We all understand the concept of the equity building in our home and adding to our retirement. So think about the things that you understand and then learn a little bit more about them, right? Every day you should be learning something new. Stay current on taxation. Stay current on what is going on, because deploying the strategy that I just talked about, there is no better time to deploy a strategy to converting things into a tax-free environment. Now, has the IRS come down on IRAs and said, we're going to cap a Roth at $10 million? They absolutely have. Can they do that more? I don't know. We don't know. But having $10 million of tax-free assets, tax-free income, I mean, come on. That is a lot to be able to put into that bucket. Professional tax assistance. Talk to people. Don't talk to one, talk to many. Make sure that the strategy that you're deploying is the right strategy for you. Make sure that it's not going to get you in trouble down the road. Nobody wants to be audited by the IRS. Patience and long-term perspective. Investing in alternatives sometimes requires a considerable amount of patience. Making sure that you have the time to investigate, understand the investment. Patience in making sure that you realize that if an investment says it's 12 months, it can go into default. It could take longer, depending on if it's a judicial state, a non-judicial state, the rigmarole that we have to go through to take investments back. Be patient. There is some long-term perspective that you have to consider. And when you invest in a retirement account, it is a long-term perspective. This isn't day trading. This is a long-term plan that you're putting forth. And an IRA, a self-directed IRA, it should be part of that plan. All right, scan this QR code. If you want to set up a consultation with us, talk with a member of our staff. What you hear from me, you will hear from them. If you're not sure if your account can be converted from where it's at to a self-directed IRA, let us know. If you're currently working and you're asking yourself, I have a 401k right now, can I use any of it, Carrie? Call us, ask us. Typically with 401k plans, with your current employer, the answer is typically no, unless it's a smaller employer. Sometimes they have some caveats in there. They'll let you take 10, 15% of it out. Many times they won't. If you've got old 401ks sitting out there, dust those puppies off. Don't leave them where they're at. Let us help you get those converted over, get them working. If you have IRAs at Schwab or TD or somewhere else, and you put them there because at the time, it reduced your income, you paid less in taxes, but you haven't used it and it's earning 0.1%, get it activated. use it. These options today, look at them, turn that around, make money in tax deferred, tax free environment.
Awesome. Thank you for that, Carrie. I appreciate that so much. I think that was very thorough. You hit on everything. So thank you for that. And I saw, questions in the chat. I want to hit on again that everything you guys have seen so far, as far as the investments that we've talked about and everything else we're going to talk about today, you can hold in a self-directed IRA. Yeah, so it's very inclusive, and that's exactly why we had Carrie here today, so that if you're like, oh, I want to do one of these investments and I want to do it with my retirement funds, then we've got the perfect resource for you.
Absolutely. We're here to help. If there's any questions that we can answer, let us know. And I mean anything. We've heard some crazy stuff before. And we do our own due diligence on the companies that you're working with, kind of behind the scenes. We'll check and see, how they're structured. If they have, filed with the SEC, if they're filing, their Qs and their Ks, if applicable, we'll check their business licenses. We do stuff behind the scenes to also help protect you, not from them, from yourself sometimes. Sometimes, we get involved in these Ponzi schemes. Heather just mentioned it. Sarah had mentioned it. There's so many of them out there. You really have to have the right people on your team helping you along the way to explore all of these hidden dilemmas that, don't fall into those pit holes. Let us help you.
Yeah, and I'll vouch for Kara on that one. Before I could even book a call with her to talk about this event, she's like, all right, send me your PPM for your investment, your operating agreement, And she went through it all. And I was like, wow, no one's ever done that.
Yeah. Client,
awesome.
I call that client advocacy, right?
Yep.
We're just watching out for clients. And if we see something, say something. That's what I say to my staff all the time.
Mm-hmm.
If we could help somebody save some money or deter them from investing in a company that doesn't have an active business license, like at least push it back to them and say, you might want to ask these questions before we continue. If they don't want to ask those questions, listen, I'm not the person that's looking into these investments. The client is. If they want to move forward with it, I will move forward with it. But I am going to present you with our level of hesitation. And hopefully you will take that and do a little bit more due diligence on your own.
Perfect. Thank you, Carrie. And the link to book a call with Carrie's team is in the chat, everyone. So thank you, Carrie. Thank you very much.
Thank you.
Mm-hmm.
Have fun today.
Thank you. All right, you guys can see in the chat the link to book a call with Carrie's team, and you can see the agenda for the rest of the day. So we have Ben Fraser coming up next, talking about investable megatrends for 2023. Leah is going to talk about North Texas real estate. This is like near and dear to my heart. We have so much in Texas. So I always love Leah's talks on Texas and real estate there, because we're all huge investors over there. And then we'll have Howard coming in next. And then at the end, so about 2 hours from now, we'll have an open Q&A. Some of the folks will come back. Some won't be available, but I will be there and I'll stay as long as you guys want. And if you guys would like to book a call with Sugo Capital and our team, we have a 4-point strategy call that is available to everyone. So Cynthia is going to put that in the chat as well. All right, Ben, thank you for being here. Excited to have you here. So Ben is with Aspen Funds, and actually someone on our investor relations team is invested with the Aspen Funds. So as you've heard, my connection with everyone who's speaking, we have a connection with Aspen Funds there. So Ben, so much has been changing in the last 12 months. So your talk, what are the mega trends for 2023, is so timely, and we're really excited to hear what you have to say and what you're forecasting.
Yeah, well, thanks for having me, Sarah. Super excited to be sharing with you all. So thanks for having me on. And yeah, we're going to be hitting on a couple mega trends. So we have several that we've covered, but just in the allotment of time, don't have time to go through all of them. So just going to hit 2 today. And one of them is, reducing your risk by going lower in the capital stack. And being the bank. And then the other is, phase two of the industrial boom, and talking about why industrial is set to go into another boom. So excited to jump in whenever you want me to go.
Yeah, go for it. Take it away. I'll give you this.
All right. Let's first make sure we got all the technical things worked out. So
Yep.
can you guys see my screen here?
We cannot. Now we can.
Okay.
Yep.
There we
All
go.
right, you got it.
Okay. How do I make myself bigger? Or are we okay, good to go. All right. Well, thank you all so much for having me on again, and really excited to share with you all. So I'm going to run through a lot of information. So, get ready to go for the next 30 minutes. It's going to be fun, going to be a little bit of a fire hose. And then I will be joining on the 2 hours from now on the Q&A, so I can answer any questions then if you have any as we go along. So a little bit of introduction. So Aspen Funds, if you're not familiar with us, we are an investment manager, but we are a little bit different than maybe your other investment sponsors you've seen, in that we invest across multiple asset classes. So I'll explain that in a minute. Before I get into that, got to give the little disclaimer here, right? This is not an offer to sell securities. I'm not make forward-looking statements or make things, talk about things that we've done in the past, and it's not necessarily indicative of future performance. You got to review any kind of investment material, investment offering documents at length before making any type of decisions. With that, a little bit of my background. So I'm the Chief Investment Officer at Aspen Funds, and I'm responsible for sourcing, vetting, and forming the capital for all of our investments. And prior to joining Aspen, I was a commercial banker. I was an underwriter, underwrote a lot of real estate and business loans for many years, and then joined about 6 years ago with the Aspen Funds team. Also run a podcast called Invest Like a Billionaire. If you want to learn how the ultra wealthy are investing, we talk a lot about these types of things, macroeconomic trends. And we have 3 other partners on our team at Aspen. But just a little bit of background on Aspen, of how we started about 11 years ago now, been going, and really started as an opportunistic strategy, seen kind of after the great financial crisis, opportunity in distressed debt, and could basically pick up these mortgages for pennies on the dollar and work them out into a variety of different strategies. And so our founders started in that strategy. We've really grown with the industry. We've been going now for 11 years in that space, really become one of the middle market players in this space. And then a couple of years ago, we kind of used that same approach of looking for opportunities, using kind of our macroeconomic lens to identify where we think the next opportunities are going to be. And so really how we work is a little bit different than a lot of operators that focus on one asset class and just do that one thing, and that's all they do. We look at kind of across the landscape, where do we think the best opportunities are given the current economic environment? And then how do we find the best opportunities, best teams, and best strategies to play those trends? And so it's really more of a family office approach, partly being that we invest all of our own capital into every deal that we do. So this is part of our diversification approach for our own capital as principals. We invest right alongside all investors. So we've been going, like I said, over 10 years, been on the Inc. 5000 for many years. It's one of the fastest growing companies. Forbes Finance Council, we actually are approaching $200 million in investor capital managed, 10-year track record. And one of my favorite stats, and the last one there, is that we have sent over $50 million of distributions back to investors since inception. So it's always fun to raise money because you get excited about deals, but it's, to me, way more fun to return capital and profits back to investors. And that's one of our favorite stats to share. So like I mentioned, we invest across asset classes. We invest in mortgage notes, which I'm going to talk about today, invest in multifamily, self-storage, industrial and retail. I'm going to hit on industrial today, and then also hit oil and gas and venture. And so we have a really breadth of experience, our team, which I haven't got into just for time, but we have experience across all these different asset classes on our management team. Lastly, before we dive in, we do have a podcast. Got to give the shameless plug here, but we have a lot of fun doing this where we talk a lot about the things I'm going to share today, but a little more in depth. And you can find it on any podcast platform you like. It's called Invest Like a Billionaire. Learn how the ultra wealthy are investing. So first trend, right? First one is how do you reduce your risk? A simple way to do that is being the bank. And so right now, a lot of investors are going risk off, right? What that basically means is they want to reduce their risk. They're concerned about certain things in the economy. and maybe we hit a recession, maybe we hit some slowdown of rent growth, maybe we have other things going on, maybe we have some higher unemployment coming, et cetera, whatever it is. A lot of investors are going risk on, meaning that they want to, risk off. So they want to reduce the risk. They don't want to take the chances. And one of the simplest ways to do that is to get lower in the capital stack, right? So this may be a phrase you're familiar with. I say this a lot. And sometimes people are like, well, what are we talking about, the capital stack, right? So if you haven't heard that phrase, it's a pretty simple concept, but you can see here on the chart on the right, basically, whenever you buy an asset, any kind of real estate asset, it is purchased with a certain type of capital. And that can be a combination of senior debt, mezzanine debt, preferred equity, and common equity. And sometimes all of those, sometimes just a few of those. But the farther up you are on the stack, the more risk you're taking just by virtue of priority of payment. And so most people are investing in this kind of top echelon. Most investments that you're making in syndications are in common equity. There's nothing wrong with that. We make a lot of those investments. And in fact, the industrial one I'm going to talk about in a minute is generally common equity. So there's nothing wrong with that, but you have to understand you're taking more risk when you're doing that. And especially right now, you should always be doing this where you're normalizing the returns that you're earning by the risk that you're taking, right? It's called a risk-adjusted return. And one of the simple ways to automatically reduce your risk is to go lower in the capital stack. So the further you get to the bottom of senior debt or become the senior lender, you are decreasing your relative risk in that particular asset. And so a lot of times, the caveat is, or the trade-off is you're giving up some more of the upside to the common equity, right? The common equity is taking the most risk, so they should be rewarded for that. But especially in times right now where there is a lot of uncertainty, you can reduce that risk. Even though you reduce some of the upside, you can still get a really strong risk-adjusted return. So we'll talk about how we do that in one of our strategies, which is basically being the bank. And so what's better than owning real estate? It's becoming the bank. And I think there's some other folks today talking about mortgage notes. So I'm not going to spend a ton of time on this. We can hit more in the Q&A if you want later. But effectively, what you're doing is you can buy these mortgages from individual borrowers at discounted prices, and then you become the bank. You receive the mortgage payments from the borrowers. And so we call it being a lien lord versus being a landlord, right? So if you're a landlord, you own the building and you are having tenants pay you your rent, but you're responsible for a lot of things. And one of those things that you're not responsible for when you're owning mortgages, and what that is, you don't have any property management you have to worry about, right? Because the property is actually owned by your borrower. You don't have any responsibility for the maintenance. That's on the borrower again. They're the owner. You don't have to worry about tenant issues, right? One of the biggest risks in rental real estate is, having vacancy. And as a mortgage holder, you don't have to worry about that because you're not the one owning the property. A lot of times, you'll have a lien secured by the real estate, and then you can collect the cash flow from those mortgage payments. And then you can sell these potentially if needed on a secondary market that's pretty active, meaning there's a lot of ways to sell in and out of these on different exchanges and other platforms that are trading these assets. So it's actually a pretty semi-liquid asset relative to real estate, which can be a little bit more illiquid. So one of the reasons we love these asset classes, discounts, right? This is what makes the whole thing work. And we'll get into some case studies here in just a sec. But effectively, when you're buying, these mortgages at a discount, one, it gives you higher yield. Two, it gives you profits when you exit, and it gives you capital protection. So we'll get into some case studies here in a sec. But the first question I always ask, well, why are these sold at a discount, right? Well, again, there's a very active secondary market for these notes, but it's still a very inefficient market, right? And the idea of efficient markets, if you've studied finance or econ, the idea is pricing is, it's efficient. And so when you're buying certain assets, all the risks, all the upside, all the things are kind of taken into account. But in this market, it's a pretty limited niche. And so there's not a lot of efficiency built in from a pricing standpoint. And so we think a lot of these notes still trade well below intrinsic value. Not to get into all the nuts and bolts here, but again, what we're buying generally, and what we suggest people, if you're going to go buy this yourself in your IRA, as we just heard, you can do things like this, are buying cash flowing mortgages. So there's kind of two big categories. One is non-performing, one are performing. But generally what happens and what we're generally buying are reperforming mortgages. And so these are borrowers that had some type of temporary crisis that caused them to stop paying. Usually it's something that's temporary, right? So it's caused by either a job loss, medical crisis, even a divorce, something that is very disruptive, but they want to get back on track. They want to stay in the home. So they negotiate a modification and they start making payments again. Well, the banks that are selling these, they want to get rid of them because the regulators are, generally pushing on them to not have too many of these. And secondly, they're not in the business of real estate. They're in the business of lending, and they don't have a core competency in being able to underwrite the real estate and understand what's the downside of how do you get out of these if it doesn't work and they stop paying again. So that's why these are sold at a pretty big discount, trade anywhere from 10 to 50% of what is actually owed on the property. So let's get a few case studies here. This is for actual mortgages that we've purchased. This one is a single family home in Glenwood, Illinois, which is a suburb of Chicago. And first mortgage, we purchased this, was a $95,000 mortgage. The home value at this time, this is a couple years old, but $132,000. So a little bit of equity in there. We ended up buying the first mortgage, had an interest rate of 5.375. Their payment was about $650. We bought that $95,000 mortgage for $45,000. So we bought it at a 52% discount. So you think about with that discount and with the payment that we were getting, it created an effective yield of 17%, which is basically return on investment or return on purchase price. And then the other cool thing is you think about, higher yields, number one, number two, capital protection. And so you've got now a 35% roughly investment to value. So our $45,000 investment is covered by, $132,000 home. And so there's a lot of capital protection buffering that. Well, hey, say the market's down, say it's not a good time to sell, say, you don't want to be selling the asset because now all of a sudden the home was worth $46,000 and you barely break even. Well, the great thing is we always have a secondary exit strategy, which is if we go and take ownership of the asset because of non-payment, we could turn it into a rental. And, we always look at what's called rental equivalent. And that in this case was about $1,800 a month, well above the $650 that the borrower's paying. And this does two things. One, it creates a secondary source of income for us if we need to. And two, it also creates a stickiness factor with the borrower, right? If they're paying $650 a month, but the equivalent rent in that market, if they have to stop paying, they have to leave, is $1,800, almost 3 times or 2.5 times what they're paying. Well, they're going to probably get back on track and figure out a way to make that mortgage payment, right? So that's one of the things we love about this. These are generally owner-occupied properties. And the really cool thing is if they ever sell the property or refinance us out, we capture that discount of 52% because we get paid out at the $95,000 number. This is another case study. This is a second mortgage we bought, right? So there's first mortgages and second mortgages that you can buy in this niche. So this first mortgage was about $143,000 balance. Second mortgage was $52,000. So total loan $195,000, home value is $220,000. So LTVs are a little bit higher, but here's what we did. We bought the second mortgage of $52,000 at $35,000. So a 33% discount. And their interest rate on the second mortgage was over 11%. So that's, common for second mortgages. They're higher yields because of the additional risk. But our effective yield in this case, again, was 17%. And this was an actual loan that we owned for 4 years. They made a perfect payment stream on all their payments for 4 years. They ended up refinancing us. So we got $25,000 in monthly payments, and we got $50,000 when we got paid off, which was the balance at that point after 4 years. So made a nice capital gain on that. So, not to spend a whole lot of time on this, but we have an income fund. So you can do this yourself. You can go on platforms. You can go buy these notes, stick them in your IRA. They're amazing to do that. It's definitely like anything. You have to be an active investor. You have to be willing to do the work, to do due diligence, to manage these, there are some advantages to doing that, but definitely got to learn the ropes before you do it. The other way is you can invest passively into a fund like ours that is, pooling mortgages together, and we're paying out net returns. We're paying out 9% monthly, 1,100 assets. We actually have liquidity in this fund on a best efforts basis, and then we've been doing this fund for almost 10 years now. So we've never missed a preferred return payment over the last 116 months. So there's a great thing there. You can just get some income, reduce your risk, and get into a great little asset class. Okay. Second megatrend, second investable trend we're looking at right now. This is industrial boom stage 2, right? So we've seen a really big boom in industrial over the past decade. And this has really mostly been driven by e-commerce, right? So e-commerce trend has really upended the whole retail industry. It's driven a lot of, consumers to Amazon and to other things that are they're purchasing online, right? So it's led to a huge boom in warehousing, logistics, and while that is not stopping anytime soon, that trend is slowing, right? As far as e-commerce continuing to take more share of retail sales, it's going down. Well, the question is, well, then what is leading to the next industrial boom? And it's really going to be led by two things. One is reshoring of inventory and bringing manufacturing back to the US. So this is kind of a novel concept, because for the past really 20 plus years, we've been globalizing, we've been outsourcing manufacturing to other countries, but the trend is reversing. We're actually at the very beginning of this reversal of the trend that we think is going to be occurring for the next decade plus. I'm going to share just some initial charts here of why that's the case. So some of the first thing is, right, China has been one of the biggest manufacturing economy for the past few decades. A lot of manufacturing has been outsourced to them. But what's really interesting is they have had the fastest labor appreciation in human history. There's been a 15-fold increase of average wages in China since 1999. So that in of itself has driven a massive recalculation of risk reward and is it worth it, aside from all the socio-political stuff going on in China, right? And so, China is a whole other conversation, but they are relatively becoming more costly than most other manufacturing areas, including the US, which I'll get to in a minute. A little bit more in China here, and this is more of a digression. We have a whole thing on China that we've done on our podcast, but basically, China is in a very challenging demographic situation. So because of their one-child policy, where they only had one child for many decades, they've kind of run up massively in population growth, but the future of population growth is very abysmal, really. And their working population, this is a chart that shows working age population relative to total population, expected to drop by nearly half over the next 100 years. And so the percent of the population that will be working is expected to be around 55%. That's crazy. We've never seen that before, right? Because there's the current population is so large, and the populations coming behind it are so small in comparison. There's not going to be enough labor to support this very aging population over the next several decades. So this is a whole other deal, but part of that is driving this labor appreciation. And that's kind of the point here, is because there's they actually have pretty massive challenges in labor over there right now. They actually have a 10% unemployment rate for a lot of these types of jobs. Some people expect it could be as high as 15 or 20% because they don't have the workers for manufacturing jobs. So that's one big driver, right? The whole kind of recalculation of manufacturing, where does it make sense? This is in the US. We're seeing supply and demand really being very strong. And so you can see vacancy rate here. The chart on the left, the orange line, is showing average vacancy rate over the past 20 years. It's gone from about 10% to right now around 4%, or just under 4%. And you can see here cap rates, the orange line, which is basically the unlevered rate of return, how you price a lot of real estate, has massively dropped over the past 20 years. And if you look at the most recent data, industrial real estate is actually the single asset class, probably industrial and retail, that have been hit the least hard by the rate of increases of interest rates. And so, office has been hit the hardest. Multifamily has been hit pretty hard in certain areas. Industrial has been hit probably some of the least from a value standpoint and a cap rate standpoint. And the reason is all the things I'm sharing and things I'm about to share here. So we're seeing, vacancy rates have dropped massively, but what does that do when there's less supply? That's driving up rent growth. So we've seen the blue lines here are rent growth over the past several quarters. We continue to see rent growth very strong in industrial. And this is, latest demand. I was typo, they're not 800 million, 330 million. So there's been this is just this year, right? So a lot of people are concerned, well, with the potential recession on the horizon, with the economy kind of where it's at, are a lot of people stopping expansions? Are they not going to actually be investing in, that next industrial building? Well, just this year, even still, they're expecting, this is from Marcus Millichap report, 330 million square feet to be absorbed of new supply being absorbed this year, which is well above historical numbers. And you can see here the last sentence highlighted. This dynamic will keep national vacancy well below any reading prior to 2021, despite a second consecutive year of record level of construction. So we've seen a massive level of construction hitting, but it's still being pretty well absorbed by the market. And so what's actually happening is we're seeing a drop off in a new development because of the current environment. It's harder to make developments work, but the trend is still there. The demand for the space is still there. And so we're actually favoring development projects right now, because as you kind of build these out over the next 12 to 18 months, the demand is still there. The competition is going to be lower. Absorption is going to be way higher again. So this is going back to the kind of reshoring trend. We're seeing this was the number of jobs that are announced, reshoring jobs, which are bringing manufacturing back from overseas to the U.S. We're seeing record number of jobs being brought back to the U.S. Another big thing here that is really caused and really accelerated by COVID were supply chain disruptions, right? We all remember the crazy supply chain. That was the excuse for everybody back in COVID, right? You couldn't get something. That was supply chain. Well, we're still having some challenges there for a lot of things, but it's something that has kind of fundamentally changed the calculus for a lot of these companies to decide of how they want to build their supply chains, right? Because the historical thought was, with globalization, we can outsource to the lowest cost center for manufacturing, for logistics, and we can create this perfect supply chain that when we hit the button, we need something, it arrives right when we need it. Well, we found out that doesn't work when you over globalize, which I believe we have done, and have over relied on these counterparties that not only have issues, economically, but also have issues sociopolitically. And we want to reduce our reliance and risk on them. And so a great case study here is Ford, right? So if you were trying to buy a car during COVID, which I did, I bought a Ford truck, which was the stupidest thing ever, but I really wanted one. And, they had a massive supply chain challenge because they had all these cars that were finished, all the assembly line, work was done, but they were sitting in parking lots. They had tens of thousands of trucks sitting in parking lots they could not sell because they didn't have the microchips to put in them and to actually make them work. And there was massive, backlogs of supply chain, I think Taiwan mostly. And so what's happening now is, the question is, how important is that microchip, which maybe it costs a little bit more to manufacture in the US and to store it as inventory here in the US, but it's so insignificant relative to the overall cost of producing the car that it's very, very important that they have that critical component to their process available when they need it. And so what's happening is a lot of companies are shifting from adjusting time inventory system to adjust in case. And so they're actually holding the inventory in warehouses in the US, and they're also bringing manufacturing of certain components and things like this back to the US. So we're seeing, again, manufacturing employment rising for the first time in decades. It's been a reversal of a long-term trend. The other really big driver here that is shifting the calculus for a lot of manufacturers is energy, right? And we actually love investing in energy. So this is something which we track a lot. And if you look at the biggest cost of operating manufacturing, is labor, and then it's energy costs, right? And in Europe, they're a very different scenario than we have in the US, right? We have a lot of energy that we can produce here and be energy independent in the US. In Europe, they don't. They don't have the natural resources in Europe that they do here in the US or Middle East and Russia. And so they have to import everything. Well, their natural gas is generally trading at anywhere from 5 to 15 times higher than what we're trading at. And so that is causing this big input cost needing to basically shift how they're allocating. So here's the reasons they're doing it. Sarah, I think I lost track of time, so I'm going to run through the last thing here. So last thing is industrial development. We really like this. Part of the reason is you can build into this long-term trend. It's a lot cheaper to build than to buy right now. And because of these lot of demand for these types of properties, the numbers are very intriguing. So last thing, I don't have a QR code, not as fancy as that, but we have a little webpage here you can go to, investwithaspen.com. And we have a free economic report, and we actually go through this megatrend and about 4 others in that free video course and report. And you can check out more of the things that we're looking at.
Love it. What I love most is that was totally different than what everyone else is talking about. And it's exactly, very timely. So like I mentioned, I pivoted a lot over the last 12 months, and that's because of looking at economic trends, macro trends. And that's exactly what both of us are doing. And it's extremely important for the longevity of our portfolios, the longevity of our wealth building. And everyone in here who's listening, I'm sure you've gotten the message by far that you can't just niche down on one thing. You have to look at what's going on in the world to know when it's the right time to pivot into different asset classes. And as well to know which operators, which fund managers are in those spaces, so that when it's time to pivot, you know who to go look for. Like I don't have industrial, but if industrial is the thing that you're wanting to go into, then finding Ben and reaching out. So thank you for the overview, Ben. Much appreciated. Any last?
Yeah, thanks for having me. It's great.
Yeah, you're very welcome. All right, and you said you'll be around for the Q&A?
Yep, I'll come back.
Okay, see you in an hour. Thank you.
All right, thanks everybody.
All right, up next, Texas real estate. Let's see, let me make you co-host. Oh, you're co-host. Leo, you here? You ready to jump on? There we go.
I'm here.
How are you?
I'm doing great. How are you?
I'm very good. Thanks. Thanks for being here again.
Thanks for having me.
Yes. So audience, in each intro, I'm letting you know how I know the person on the screen. So I don't know how many events we've done together, but each time the audience is like, wow, that was such great information. It's not like fluff. It's like data I can sink my teeth into and take action in my life today. So I'm excited to have you here. Everyone always loves hearing, the facts, because you're right in the middle of it. You're in the middle of it all. So I'm over in California. I'm not in the middle of Texas. So it's like from a bird's eye view, you're in the middle of what's going on in real estate in Texas. And so many of us have a lot of real estate in Texas. So I love learning from folks who are, boots on the ground, who are in the middle of it all.
Yeah, I feel so fortunate to be operating in Texas, especially North Texas, because we keep hearing about this nationwide real estate market crash, which for those of you that have heard me speak before, there is no nationwide market. Everything is hyper local. And North Texas is just booming. It's been amazing. I know, Sarah, you've got investments here, so you're seeing it on your end too. Most of the areas that we're working are up anywhere from about 7 to 14% year over year right now. Rents are way up. We've seen massive increases just in the last month alone, and inventory remains at all-time lows. And so we really are in a very good position. I keep hearing people talking about how there's just so much on the market and there's so much inventory because we're up, 100%. But what they don't tell you is we're still below 2017 levels, and we've grown by just so many people. So, it all comes down to jobs. At the end of the day, we're a great business climate. We're a landlord-friendly state. We've got this massive housing shortage. But at the end of the day, we added almost 300,000 jobs last year. There's only one home being built for every 5 jobs coming to North Texas. And it's been 80 years in the making, this housing shortage. It's really gotten so much worse since 1970, 1980, when we stopped building starter homes. And so what little progress we made right as COVID ended is over, right? Because as soon as we started ramping up production, rates went up. Builders had their build lines cut. They're no longer allowing them to build without it pre-sold. And so it's just exacerbating the problem. So again, one home being built for every 5 jobs coming here. It's unbelievable. And I've been talking a lot about this is the crisis of our entire lifetime. It's going to come to a head as soon as rates drop even the slightest bit. And keep in mind, we don't need the Fed to actually drop rates for interest rates to drop. All we need is for them to say, okay, we think we're done raising, because then all the investors are going to flock to lock in those rates. You're going to see rates come down for mortgages as they start to try to become competitive again. And it's going to be opening the floodgates. Anyone and everyone who didn't buy last time is going to buy now. And you've got 50% of our market as renters. You've got a lot of our areas with almost no inventory. You talk about North Texas. So we actually just expanded into Southern Oklahoma. I don't even know if you know that yet. So we started.
Didn't know that. Yeah.
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 So I had this awesome builder that, we do a ton of stuff off market. So for those of you who don't know what we do, let me give you like a 1-minute overview. I have my primary company, OmniKey Realty. We do investment acquisitions and sales and in-house property management. We represent about 1,400 investors, and we sell about 95% brand new construction off market. And so it's very high growth areas in the tech corridor. A lot of people don't realize Dallas is the second largest tech hub in the United States, chip manufacturing, that's where it's at. So that's what we do on the OmniKey side. And then on my Slaughter investing side, we do education, mentorship, and then we have 2 real estate investment funds. One that is a renovation fund here in North Texas. We have that open through November. And then we have our brand new build to rent fund in Southern Oklahoma, right over the border. And these properties have over $80,000 built-in equity on these fourplexes. Fantastic opportunity. And we're piggybacking on this area that has one of the largest employers in Oklahoma. It's 20-30 minutes into main areas of DFW. You can get into Denton in 30 minutes from this property. And there's only 1 property for rent on the market right now in this area because there's such a housing shortage. There's not even enough homes to hold all the people that work in the city. It's like less than a third. So anyway, incredible opportunities in North Texas right now. And we're just very excited to see what's going to happen as rates come down.
Yeah, I love it. And so audience investors, when you're thinking about building your portfolio and what you're putting in it. So some of the categories, things to think about are, do you want to be active or hands off? And so, and once you decide one of those, then you're going to begin your due diligence, right? And so almost everyone says this, but I always say this, when you're doing your due diligence, first look at the team. If you're going to be hands off, even if you're going to be hands on, you have to choose a really good property management company, right? And then second is the market. So especially if you're in real estate, the micro market that you're in. And then third, you're going to look at the actual project or investment. And so what Leah is talking about, the market, it is so important because if you choose the right market, then all the mistakes that might happen or all the levers that might be pulled in the economy, as long as you have the market right, I shouldn't say as long as, but if you have the market right, then your whole investment, is very forgiving to your investment because the whole market will rise. And so if you make some mistakes and you're learning along the way, it'll be forgiven by the reason in what's going on in the market. So what Leah's talking about, the 1 house for every 5 jobs, that's incredible. That's a great place to own property. Supply and demand is totally in the landlord's favor. I have a question. Do you, and all the stats that you're talking about, is it the same for whether it any housing, or are you seeing a specific, all the rent growth and that you're talking about, are you seeing that specific to a certain type of real estate or certain asset class or all homes in general?
So I was trying to avoid that topic on purpose because
I don't mind.
All different types of property here.
Yeah.
I abhor large multifamily, and I can't stand commercial. I can't stand warehouse. I can't stand industrial. Mm-hmm. I own all of it. I own multiple properties that are over 10 units. I have my largest apartment that I own is 24 units. So to kind of back up a little bit, I have a $40 million portfolio that my husband and I own individually. And then, of course, we represent all these investors and have all their properties we manage as well. So I've done a little bit of everything. And the problem with every other property type is they're very market dependent. They're very volatile. Just having a severe housing shortage is not enough. And so for me, the thing I love about single family is there's a lot of ways to buy it and there's a lot of ways to sell it. And you're not going to be at risk of a capital call. You're not going to have, these floatable adjusting rates that you can't get out of. They're very small packages, right? So if I need to exit, it's very simple to do. And certainly for me personally, when you have the large portfolio volume that I do, that's very much on your mind. And so we see what's happening in the multifamily market right now. I think actually, Sarah, last time you and I met and did one of these, we were talking about that. And we were talking about how there's a lot of operators out there that weren't looking ahead. All they were focused on was how good the numbers looked in that moment and not looking at where we were going to be in the future. So I'm sure many of you have probably seen the headlines of the two massive projects that have been foreclosed on in Houston area from another multifamily operator. And again, the properties were not the problem. It was the way the properties were bought. And I come from a commercial real estate family. And so I grew up seeing the cyclical nature of that as well. And I think COVID has really kind of transformed that industrial office warehouse world, because we no longer have to live and work at, this close proximity to each other. And so I think we have a unique perspective here in North Texas, because we have so many people from New York and California coming here that went from this, in-office job, 45-hour commute and having to be close by, to where now there's just so much working from home. And, I really, candidly, I did not think it was going to stick as much as it has. I thought as soon as COVID was over, we were going to be back in offices. That doesn't mean I went and invested in a ton of office space. I didn't, because I understood the risk that COVID 2.0 or 3.0 or whatever the next crisis is, that we've now have this precedence that's been set that says that we can close offices. And so for me, that was super dangerous. But the thing about it is, at the end of the day, there's opportunities to make money in every asset class. What I like about single family is the stability. And when I say single family, I'm really talking 1 to 4 family. Our new build income fund in Oklahoma is fourplexes. So although a lot of people consider that multifamily, we're talking the big on-site management. We're talking where you're competing against yourselves in unit counts, where you're having to do massive equity plays to be able to get the returns that people want. And, I'm just kind of at the point in my career where I don't need to do that anymore. There are fantastic operators out there, though, making great money in multifamily and doing it right. So it just goes back to diligence. All the things that you talk about every time I hear you. One of my favorite things about you, Sarah, is that you are all about education, like I am, empowering the client to understand how to vet a deal, how to vet a person, and how to vet a market. Because at the end of the day, North Texas is a great market. There's lots of great markets out there. Arguably, I think North Texas is one of the best, but you can have the best market, you can have the best product, but if you have the wrong people behind it, it will never make money. And I think that's the hard lesson that a lot of people are learning right now.
Yep, 100%. And everyone who's listening, you guys are going to get, I think it's on Saturday. So I've been telling everyone there's a three-part email series. It's going to be Friday, Saturday, Sunday that everyone gets who attended this. And on Saturday, the majority of the recording that you're going to be sent is around doing due diligence on the team, the market, and the property. So if you guys want to deep dive into that, pay attention to Saturday's email. Leah, something I talked about at the beginning was when you're building your portfolio, to choose assets that have different risk profiles, like uncorrelated risk. So I'm going to say some of the 3 major things for multifamily, like the 3 biggest risks, or the 3 biggest things that have happened, especially in Texas, that are hurting multifamily investments. So, something that's 100 to 400 units. So number 1, everyone's pretty aware of debt. So if you bought 3 years ago on a variable rate debt, now your mortgage payments have gone up. Number 2 are taxes. Taxes have almost doubled for multifamily. And then number 3, insurance has almost doubled. So price per unit, 3 years ago, we were underwriting at like $350 a door for insurance, and now it's $1,000. So it's almost 3x the insurance costs. So I'm wondering, these things that have made multifamily, lowered the cash flow in multifamily, for some of those that were purchased a while ago, are you seeing those same 3 levers affect single family investments?
Yeah, so major property tax reform is on the horizon here in North Texas. So on the Texas side, our governor has said he's going to completely disband property taxes. We have this massive surplus that's larger than the operating.
Completely disband.
Yeah, it's actually pretty incredible what's happening. And so a lot of people don't even know what's happening unless you own property here and you're paying attention. So we've been real vocal about this. So our House and our Senate have been working for months to come up with a plan that is going to satisfy the governor that he would sign. It has been agreed upon, it has been signed. They are doing essentially cap rate compression on the school taxes. So you're going to save quite a bit of money. They're doing it from school taxes because that's the largest part of the bill. And the state is essentially offsetting that and buying down the rate. In addition to that, they've increased the homestead exemption for people who are homeowners here. They've changed the state income laws in terms of other things that qualify and amounts of what things are going to be. And so this is like a 3-year plan right now for the rate compression. And then after that, they're going to continue, and they are moving to completely disband property taxes. We don't need them anymore. The city and the county and the area is rich enough that we no longer need property taxes. And our governor has been very clear that they're going to go away. So right now, this new reform actually applies to investors. It's for properties that are worth under a few $1 million. And so pretty much all single and small multifamilies apply to this, and it gets voted on in the November election. And of course, it's not costing the citizens anything. It's saving every single person. And so it's expected to pass with flying colors, and it will actually prorate backdate to this year's tax bill. So it's quite significant, but the amount of the surplus that was used for this was less than a third. So to give you an idea of how large our state income surplus is right now, it took very, very little of it. So this is just step one. They're going to see how it goes for the next 3 years. And then I full well believe in the next decade, we will no longer have property taxes here. And what's interesting is states around us that are doing so well, like Oklahoma. One of the reasons we targeted that area, Southern Oklahoma, is piggybacking on the growth of Texas. It has one of the lowest unemployment rates in the entire country. The area that we're talking about is sub 2%. And the Oklahoma governor has said that he's actually going to be disbanding state income taxes, which is going to be astronomically just transformative for Southern Oklahoma and Oklahoma. So they're starting that process right now. So we're going to see a lot of changes in these states down here that are doing so well, and mostly because of the surplus that they have because of the money that's coming in. You have to understand that these jobs that are coming in, these employers that are coming in, specifically here to North Texas, we're carrying the weight. You know, almost half of the Texas enterprise money got used and is getting used here in North Texas. We've got this new chip manufacturing hub with billions. The largest deals in Texas enterprise history have all been done in the last few years here in North Texas. Texas Instruments, Finisar, Globitech. I mean, these are transformative for the entire country. You know, not only supply chain, but access to vehicles, cost of goods. We are talking about a new industrial revolution here in the United States. And the problem is the news is so busy focusing on other things that they're just not talking about it. And so anyway, it's incredible what's happening. Cash flow here is for us. We've seen almost no change in insurance on the 1 to 4 family market. We are still insuring our properties less than $100 a month. And that's for, you know, top coverage. Property taxes, we've been protesting every year, much easier to do on the single family side. And then of course, this new reform is going to save the average person $40 to $50 a month. So it adds up pretty quick. And then in addition to that, we just aren't seeing all of the lending issues that you're seeing on the multifamily side, and very easy exit. Most things are still selling very quickly, lots of multiple offers. And so just a very different world. But I think that goes back to what I mentioned at the beginning, the many ways to buy, many ways to exit. And that's one of the benefits of single family.
Yeah, definitely. So that's interesting that, so in multifamily, in case you guys aren't aware, and in most commercial syndications, so apply what I'm about to say to, you know, a commercial retail park or medical office park, anything large, you know, we're buying it for $50 million. We used to be able to buy it with 70 to 80% leverage, so 70 to 80% debt. Now we're able to find about 50%. So a lot of folks are aware interest rates have gone up, but also the leverage has gone down. So when you're buying something for 50 million and you need 20% down, okay, that's easy to do. When you need 50% down, you have to raise $25 million. That really reduces the number of properties out there that I will consider buying, because, you know, we need to keep the margins for our investors. We still need to offer investors 20% annualized. We can't say, oh, well, we'll just, you know, now we'll offer you 5% annualized. No one would do that. So it hasn't adjusted. So what I'm hearing you say is that has not happened in the single family home, where the amount of the mortgage has gone down to like 50% of the price of the property. Is that correct?
So before I get into that, I want to say one thing on top of what you just said too. It's so much about not just the amount of financing that we can find on the multifamily and commercial side, it's getting it to cash flow. Even if you could find 80% financing right now, they don't cash flow. And so any deals, making them work is just so much harder.
Yeah.
On the single family side, so we have direct local banks that we partner with. We don't use the big guys. And like the product that we typically use for our investors right now is a 30-year amortized 7-year fixed product. It's cheaper than Fannie Mae, doesn't have all the same underwriting requirements, and they actually can do up to 80% even on cash outs. And so there's no rate hit going from 71 to 80%. You don't get any rate benefit until 70. So on the single family side, we're still easy access to 80% financing and very easy qualifications. Where things have changed is actually credit score requirements just for the conventional Fannie Mae side. And so right now, in order to get top rate, top interest rate, lowest rate you can get, you typically have to have over a 780 score. And so that's really where we've seen the difference. What was considered prime credit before has changed. The threshold has gotten even stronger. And so the direct banks that we work with, they don't work that way. They don't hit you if you have a 700 score. But where we see the problem in a lot of operators is that they don't have those connections. They don't have these unique programs because, you know, the money to go into those programs and making those connections and getting that set up is really more on the commercial and multifamily side. I do think that's one of the things that's pretty unique about us and the way that we operate in North Texas is not only are our funds on the single family side, but so is our entire investment acquisition individual model too. So everything that we've done, everything we've built, all the connections and programs that we get in place, they're all designed for that 1 to 4 family. And that is very hard to find. Usually the best and most competitive terms are on your big deals.
All right, so taking a step back and going back to some of the things I said in the beginning, like how to decide for investors, like option A, is this better for me? Option B, is this better for me? I'm going to call out some really key differences. So working with OmniKey, you don't have to be an accredited investor. You're going to own properties in your own name. You're getting the mortgage in your own name, and then your company is, you know, providing a turnkey solution. So there's a couple benefits there. You don't have to be accredited. The scale at which you want to operate is more open. It's much more liquid than going into a group program. And at this point in time, at least, so we've been talking about like, you know, everything's in a cycle. So you need to know about different investments so you can move some over here, then move money over here. At least at this time in the cycle of both of these asset classes, the cash flow from the single family or the small multifamily is much higher than the large multifamily. So for folks in here who are really want to own real estate and really want high cash flow, OmniKey is going to have better choices for you, better options for you than going with large syndicators. And it's not just myself, it's across the board, whether it's commercial, industrial, anything. So I want to throw that out there. If you, in the beginning, you know, you wrote your answers to the questions and your number one cash flow, monthly cash flow, like right now is your key priority, then OmniKey is the group that you would want to work with as far as taking a look at everyone who's on this summit today. So I wanted to just really point that out, the strength and who it's right for. It is a little more hands-on.
For just a minute, I just want to tell you guys, when we talk about the people in this industry with integrity and the people that we really want to align ourselves with, not only from an education perspective, but for partnerships, investing, Sarah embodies all that. You literally have a multifamily person up here telling you that they can't give you what's best right now. And I don't know any other, and I mean any other multifamily syndicator who would stand up here and tell you that right now. And so Sarah, I know I've said this before. I have so much respect for you, what you do for your investors. And, you know, at the end of the day, we're all human. We're all on the same team. We're all just trying to make a living for ourselves and help other people do the same and exit that kind of 9-to-5 life. And so just huge respect for you. Yeah. And it's interesting because everything is cyclical, right? And so a few years ago, we were sitting here saying very different things. Yep. And I think we're going to get back there very quickly. Mm-hmm. And so, you know, this is a very interesting time for those of us in the market because I think more than ever, market dependency area by area right now is going to become key because I think, and I don't know what you think, but I think that we're going to see a lot of markets do very poor, very, very poor. And we're going to see markets that are already doing well go incredibly high to a point beyond unaffordability. You know, One of the reasons why people like you and me targeted North Texas, for example, is we're the fourth largest metro in the United States, and our average price point is still under 400,000. And look at LA, Chicago, New York. And then the report just came out that said that we're going to overtake every other metro by 2100. That's how quickly we're growing. But then you look at other areas like Las Vegas, you look at areas in California and New York that were predominantly viewed as these strong markets, even coming out of cycles, and we're just not seeing that now. And so it's not even, to me, anymore so much about property type, because cyclically, multifamily is going to recover. It's going to get back to a point where you can get good deals. And I don't think we're far away from that, because you're going to have a lot of banks needing to exit assets. Where I'm concerned is that people are still continuing to buy in the wrong areas. And that's what concerns me.
Yeah. We bought 10 or 11 properties last year, large apartment complexes. This year we've acquired 2. So, but we're still going to acquire more next year. It's not like we're saying, hey, this is bad, we're getting out. We're saying there's fewer good deals, and they're not for everyone. They're not for folks who are living, if this is your retirement income and you need to live on the cash flow, then the multifamily is not for you today, unless you invest a very large amount. But it is still great for wealth building, and it's still great for folks who want, 100% hands off. So it's really about, knowing the options out there and being able to adjust to the cycles, like you were saying, definitely.
The big thing I say about multifamily, and even our new renovation fund is doing it this way, but you have to renovate and have equity capture to get the maximum return when you're doing these multifamily projects. That's where all of us make our money in multifamily. And the problem is when you can't say where the exit loan is going to be, that model becomes very difficult. And so you've got a lot of operators out there still guessing. They're still guessing where they're going to be in 12 or 24 months. And that's how you have these guys that acquired last year getting foreclosed on right now. Whereas you have operators like Sarah that are sitting here saying, well, I'm not going to make that guess. I'm only going to operate on what I can know. And that's where that integrity comes in. And, so on the single family renovation side, we don't renovate for clients. There's just no way across 1,400 people we could do that. So that's why I started the renovation fund for single family. And we've had, equity capture close to 30%, 25% on almost every property. But it's within my little realm of control, right? I'm renovating 10 properties at a time. It's very small. It's very simple. It's cash ownership. We don't have to exit. We underwrote it at cash only to make sure that, we intend to finance and the returns skyrocket, but we didn't want to make a guarantee we couldn't do. And going back to your point about fundraising on the multifamily side, as a multifamily investor, you can't go really pay $50 million cash for a property.
No. Some people can, capital cannot.
Yeah. So it's it definitely is the time for single family renovation right now, but it's very, very difficult, candidly, to do a fund in single family renovation and make a lot of money because there's so much time for the person who's overseeing the renovations and things. And so for us, I already had the built-in team to do that because I've been doing that for, almost 2 decades. Most people don't have that. We all have a hard enough time finding contractors as it is. And so, it's finding what works in that moment, but knowing that it might shift in a week or a month or a year and being fluid. We all just have to be fluid right now.
Yeah, definitely. And that's what this is all about. This event is being fluid, and it's a big world of investing and knowing when is the right time to go into which asset class. So it sounds like there's 2 ways people can work with you, maybe 3. So you have a coaching program, so education based, the turnkey individual single family homes, and then a fund, correct?
2 funds, that's correct.
2 funds. So what is the best way for people to get in touch with you if they want to learn more about any of those things?
The best way is to go to our main site, wealthandrentals.com. That's wealthandrentals.com. And that'll direct you to everything that we do. We do tons of free education every single month. We have a virtual property tour coming up next month. And as our gift to everyone attending today, if you want to come on one of our bus tours and see the chip manufacturing and the new Silicon Alley, we'd love to have you out. That's typically a $50 cost. We're going to give that to you as our gift for anyone attending today. And so you'll get that information to register for one of our tours as well.
Awesome. And Cynthia, if you can throw that information in the chat for folks, that would be awesome. Any last recommendations or words of wisdom for folks who want to be in the alternate asset investing space, how to make choices and how to be really confident about those choices?
So I'll leave you with three thoughts. Number one, there is no greater investment than real estate, in my opinion. There is no greater hedge against inflation than real estate. As we've seen, the dollar becomes worth less and less. And so not only from an ownership perspective, there's only been a few years down in the last 70 years in real estate. You can look at the charting. I teach this. One of the first things I open with is that real estate historically rises. And that is just a fact. And so for us in times right now of inflation, and I don't know if you saw the numbers that came out today on the market numbers, but real estate is just growing and booming, and this impending crash is not happening. So if you want to park your money somewhere where it's going to go up in value, not down, real estate is your answer. Number two, I'm going to tell you that if you are not buying now, you will wish that you were. If you are interested in single family, small multifamily projects, you are going to wish that you were if you're not doing it now, not just in my market, but in any market you're interested in, because we are not creating enough housing. We have not been for over 50 years, and it is going to come to a head. And of course, supply and demand means lower supply means more demand and higher prices. So very, very important. And then the third thing that I'm going to leave you with is pay attention to the news, but be cautious. Again, there is no nationwide market. You have to make sure that you are doing your research, doing your due diligence, and understand that the majority of people up there speaking on these news channels are paying to be there. They are paying a fee to speak to you. And so at the end of the day, you need to do your research, not only on the market, on the model, but also on the team. And whether that's real estate or some other form of investing, stocks are not the place to be. I think stocks are going to have a very hard time going into election season. And I'll add number 4 on there. Historically, election years are very volatile. Don't get surprised if you see volatility the next year. It does not mean the market is crashing.
Love it. Love it. Thank you for your wisdom as always. And I am looking forward to the next time we get to meet and talk about what's been going on, because it's always changing and I always learn so much from you. So thank you very much.
Thank you. I'll be back at the Q&A.
Okay, perfect. And Cynthia put in the chat links that you guys can click on to learn more about investing or learning with Leah and our company. All right, thank you. Next up, you guys, we have Howard. Howard Robbins. How are
Sarah,
you?
good to see you again.
Yeah, it's good to see you again too. Well,
I was actually just listening to some of Leah's presentation there toward the end, and I couldn't agree with her more. Real estate is definitely the place to be.
yes, as long as you choose the right kind of real estate, because you can get in a lot of trouble with real estate right now, and you can make a lot of profit in real estate right now.
For sure.
It's all about, like she said, there's a lot of asset classes. There isn't one real estate market. There's different asset classes. There's different locations. And so making sure you're doing what's right for what's going on right now is so important.
Definitely.
Yeah.
Definitely.
Well, you've got your screen up. You look ready to go. So I'll just hand you the controls and let you rock and roll.
Very good. Well, I appreciate you giving me this opportunity, and welcome everybody to this presentation. I'm going to come at the world of real estate from a little bit of a different approach than maybe some of you are accustomed to. And maybe some of you have had some experience investing in notes or some other type of private lending. But here at Ignite Funding, we kind of specialize in a specific type of note. They're frequently referred to as trust deeds, but really what you're investing in is a promissory note that's collateralized by real property. And so let's kind of dig into the nuts and bolts of it all. Before that, my attorneys say that we have to provide you with a disclaimer, letting you know that all investments carry with it some form of risk. So please do your own due diligence and ask any questions that you might have. So let's talk about trust deeds, because this is a very common name, and it's a type of investing that's been around for a long time. But the name trust deed is a little bit misleading, because a deed of trust is a legal document that's filed in the county recorder's office and has the effect of putting a lien on a piece of property. And so that is the security for the actual investment. But what our investors are really investing in is called a secured promissory note, or an interest-bearing loan that is secured by real property. At Ignite Funding, we specialize with notes given to real estate contractors and developers. So these are not like mortgages that people use to buy houses. These are short-term financing instruments that are used to acquire and raise capital to develop real estate. And what we do that's kind of unique is that we take each note that we originate and service and we fractionalize it among a group of investors. And those investors get to share in the interest rate that the note produces, which is typically 10, 11, sometimes 12%. Now that's an annual rate of return, but we pay the interest out to our investors on a monthly basis as we collect it from the borrower. So it is a great way to create a stream of income with your capital. And your capital is, again, protected by that recorded deed of trust on the piece of property that is being developed. So that in the worst case scenario, as a last resort, we can foreclose on the property and then sell that piece of property and distribute the proceeds of the sale back to the investors. So from a personal investing standpoint, I think that obviously the monthly interest is really the single greatest attractive feature of these types of investments. And it's what our investors, what appeals to them the most. But one thing that is not very well thought of is that these investments are completely diversified from the stock market. So it's a great way to add a level of diversification in your own personal portfolio with something that is real property, collateralized by real property, physical, tangible property. And it produces a pretty consistent double-digit return without a lot of risk. And so from that aspect, a lot of our investors will have at least a little bit of this in their own personal portfolios. The yields are very healthy, not out of this world yield, but very consistent. And Ignite Funding, we're a very investor-focused organization. So we're not looking to shoot for the moon on interest rates, but what we are looking for are working with highly credible borrowers who need access to capital to develop the real estate that they're developing. And on the other side of that equation, we are able to provide a very consistent return, return to our investors with again, not a lot of risk. So let's talk about who Ignite Funding is. So we are a licensed and regulated commercial loan broker in the state of Nevada. We are regulated by the Division of Mortgage Lending in the state of Nevada, and we are audited annually as a licensed organization. We have been in business since 2011. However, the owners of this company have actually been doing this kind of lending since the 1970s. So again, this type of investment is nothing new. It's been around for as long as people have been taking out loans against real estate. But what we've been able to do that makes us unique among other brokers out there is the way we fractionalize these loans down to a minimum investment of $10,000. And sometimes we'll have hundreds of investors on one loan. And that's something that not a lot of other companies have been able to do. And it's really made this type of investing available to average everyday investors and not just the uber wealthy. Again, we are focused primarily on our investors. And we try to strike a balance between providing our borrowers with access to capital that they need, while at the same time keeping the investment safe and secure for our investors. And we pride ourselves on the educational aspect and being very transparent with our investors. And our numbers bear this out. And you can find these statistics as well as many others right on our website for all to see. We try to show what it is that we're doing. And these are just some of the statistics that we provide. We also have statistics on our default and foreclosures. How as rare as they are in our business, we actually present those to our investors and put them on our website for all to see. So I would encourage everybody here attending this presentation to spend a little time taking a look at not only our statistics, but some of the other informational pieces that we put on our website. So let's talk a little bit about analyzing your investments with Ignite Funding, or with any mortgage broker for that matter. For those of you who have experience in this kind of thing, you may know a little bit of this stuff, but for those who don't, it may be kind of new. So when you're working with a company like Ignite Funding, we are a little different in that we don't just originate loans and then sell them off to a third-party servicer. We actually handle the process of underwriting the loan from beginning to end. We source all of our own borrowers, so we don't buy notes from other mortgage brokers. And we underwrite, originate, and service these loans from start to finish in-house. So as an investor, you've got a one-stop shop to deal with everything that has to do with your investments. That includes default resolutions. Again, on the rare occursion that it happens, Ignite Funding will process that default and foreclosure and subsequent sale of the property on behalf of our investors from start to finish. And we keep our investors notified of that process every step of the way. Fractionalized notes, I talked a little bit about that. A lot of other mortgage brokers don't have the capacity to fractionalize these notes down to such small pieces. We do. And all of our notes are commercial grade. So we're not lending to consumers. We're not lending to people who want to attend a seminar and fix and flip houses. The companies that we lend to are professional grade companies that have a demonstrated track record in the area of real estate development that they specialize in. And while I'm on that topic, we here at Ignite Funding don't just lend on one type of real estate. We do really all kinds and different types of loans, from acquisition to entitlement to land development to construction and even bridge financing. We like to be flexible, and we like to go where the opportunities present themselves. We're not just here in Nevada, but we also lend in Colorado, Utah, Arizona, Idaho, Texas, and many other states, because again, we do like to go where the opportunities present themselves. When we originate a new loan and put it out to our investors, it'll come to you in this format. You'll see a sample here. This is what we call a detailed fact sheet. This detailed fact sheet will give you information about the property. It'll give you information about the borrower. It'll give you information about the loan terms, exit strategy, as well as many other things. And this is designed to give our investors the ability to do their own due diligence and analysis of each individual project that they invest in. And, while I'm on that topic, we are, just to be clear, we are not a fund of investments. You're not buying shares of a fund, and you're not buying into a syndication. You're actually going straight to the source and buying a fractional interest in an individual note on an individual piece of property. Included in these detailed fact sheets, the obvious things: the location of the property, the type of loan that it is, the term of the loan, 9 months with one optional 9-month extension period at maturity. I always like to tell my investors to expect 18 months, but frequently these loans do pay off early. The yield that the note is offering our investors, and the loan to value if we have a third-party opinion. So if we do not have a third-party opinion, we will not advertise this on the fact sheet. We do have an opinion of our own, but we don't advertise that because it is considered biased, and since we're the loan broker. However, I am more than willing to talk to any of our investors at any time about how we came about the valuation of the property and our methodologies used to determine that. One thing you'll notice with our notes is that we are always in the first position. So this is not second trust deeds or some other type of mezzanine financing. We have first claim to the property, and we do a preliminary title search in every case to make sure that we are indeed in the first position, so that if the worst case scenario were to happen, that property we could foreclose on and subsequently sell it to recover our investors' principal. Once you make an investment with Ignite Funding, we're going to provide you with specific documentation that shows you have an interest in this piece of property. So this example that you see here is a recorded deed of trust that is recorded in the county recorder's office. It's where these investments get their name, trust deed investing. And the Exhibit A is a listing of all of the investors on each individual note that is, again, recorded and according to their fractional ownership of that particular note. And that fractional ownership would translate to the property itself in the event of a default and foreclosure. So this, along with a final title report on the piece of property that shows that it's free and clear of any other encumbrances, as well as a copy of the executed promissory note with the borrower, are just three of the basic things that you'll receive for every investment that you make with us. So, let's assume that you guys want to get some more information or learn a little bit more about how we do things here at Ignite Funding. We do have several sources of information that you can access. One of our most recent additions about a year ago was a podcast that we started doing on a regular basis, weekly podcasts covering a variety of topics. And the ones that I like the best are the ones where our borrowers, the principals of these construction companies, will actually come into our offices and talk about the projects that they're working on. And they're very insightful. Because you can learn a little bit about what their thought process is, and you can learn a little bit about what's happening in their specific area where real estate is being developed, and it can help you determine whether or not you want to invest in that particular type of investment. You can find these episodes of Deeds in the Desert on Spotify or on Apple Podcasts or even on YouTube. And you can go also to the Media Center on our website, where you can access the various topics that we have covered in the past. And that is also right here, media@ignitefunding.com, the media room. Also, if you are interested in monitoring our deal flow, you can opt in for our text message alerts. So one of the things that has happened with us in the past few years is that we have grown very dramatically. We have about 3,500 investors now, and sometimes these loans will come and go very fast. So we wanted to be fair to all of our investors, big and small. And so what we did is we set up a text message alert service where you can be first notified when a new investment opportunity is released. Sometimes they're gone in an hour. Sometimes they stick around for a couple of days. But if you are interested in monitoring our deal flow, the best way to do that is to text ALTS to that phone number, 702-919-4281, and that will opt you in for our text message alerts. And then going forward, you'll receive information every time we release something new. So let's say you decide, okay, Howard, that sounds pretty good. 10% is a nice rate of return, and monthly income is something I like. What do I do to get started? Well, we've tried to make our process very simple for our investors. First step would be to open an account, and we have a place on our website where you can do just that. It's just a matter of filling out a form. One thing I want to make clear is that we are not a custodian, so we never actually hold your money. The purpose of this account is to generate the loan documents for the individual investments. It's not a custodial account of any kind. But once you have the account open, then you can actually pull the trigger on an investment that you're interested in. And that's the next step would be to select from something that we currently have available. And they do come and go very fast, but we're putting out about 100 loans, unique loans per year, about 2 to 3 new ones every week. So there's a steady flow of old loans paying off and new ones being originated all the time. Once you've selected an investment, we're going to send you the loan documents by e-sign. You'll complete those loan documents, and there is a one-page special power of attorney that has to be notarized. And then you send the funds to us, usually by wire is the most convenient way. Then once we receive the loan documents and the funds, and the loan has been executed with the borrower, the interest starts accumulating from day one. And if that happens in the middle of a month, you may only see maybe a half a month's worth of interest the following month, because interest is paid in arrears. But then going forward every month, you'll get a full complement of interest all the way until the loan is repaid, at which time the principal will come back to you as well. So once that loan is executed, or once the investor is assigned into a particular loan, this is when you get to sit back, relax, and watch the interest payments come rolling in. But you'll also receive all of the post-closing documents, which include that deed of trust, the promissory note, and the title insurance report on the property. Collecting the interest, obviously the best part of the program, and it is paid out by the 15th of every month. And then sometime during that 9 to 18 month period, the principal will be repaid, usually by the borrower refinancing or selling the subject property. And once that principal is repaid, it'll be sent right back to you. At that time, you can choose to participate in one of our other investment opportunities, or you can redirect those funds elsewhere. It's entirely at your discretion. So when it comes to investing, it's important for everybody to think about where the funds will be coming from. And we have made it possible for you to invest your dollars, whether they're coming from an IRA account, maybe they're coming from business activities of some kind, or perhaps even a trust. And so the account that you set up will depend on where those funds are coming from and how you want that interest income to be recognized for tax purposes. Ignite Funding will provide all of our investors with a 1099 INT by January 31st of the following year. And you'll use that 1099 INT to pay Uncle Sam his due on the interest that you've earned throughout the preceding year. So you can set it up as a self-directed IRA where the money will come to and from your custodian. And there are a handful of custodians that we work with, which you can find on our website. You can also set it up as a custodial account of your own for a family member, or you can just invest straight cash, whether it's an individual joint account with a spouse or a trust account. And then if you own a business, many of our business owners who are clients will use these investments to create an alternative stream of income to their business enterprise. And by running that income through the business, they can sometimes expense away some of those gains. So with that being said, I think I'm coming close to my time being up, but I want to give everybody the opportunity to reach out to me and ask any questions that you would like to ask at any time. That's what I'm here for. And hopefully you found this presentation enlightening and very worthwhile. And Sarah, I want to thank you for your time and allowing me to present to your group.
Oh yeah, definitely. Great to have you here. And I love that everyone had, different perspective, different assets, different backgrounds. So thank you for making it a well-rounded event.
Yeah, my pleasure.
Awesome. All right. So we're 2 minutes early. You caught us up, Howard. Great. So 2 minutes early for the Q&A. So I see everyone who spoke is back. Except for Heather, who's on a flight. to her trip. So everyone else, all the other speakers, feel free to come back on stage. And audience, now it's open Q&A. So you've seen over the last 3 hours, a lot of information. So we started with setting our goals and understanding, why are we investing? What are our priorities? How do we want to balance our portfolio? And then we looked at, I don't even know what the count was, maybe 20 different types of alternate asset investments. You can hold them with your retirement account or not. So there was a lot of information you received. And a lot of us, we just touched on the surface because we only had half an hour to talk. So if something wasn't covered and you're like, oh, I really want to know more about this thing, now is your time. We'll stay on as long as you want. I don't know if everyone will, but I definitely will. And I think the rest of the folks will stay on for probably the next 15, 20, 30 minutes, depending on how active you guys are. So we're here for you. We love to educate. We'd love to answer any questions you have. So audience, in the chat or in the Q&A, go ahead and put your questions and we'll just roundtable it. I'm going to check the Q&A right now. And let's see, Carrie, if you want to come back on stage. Oh, I think I have to let me make everyone co-host again so they can bring their camera up. And you, Ben, come on back. There we go. All right. So I'm going to start with, there are a lot of questions about the replay. So the replay will come out to everyone tomorrow. You're on the email list. We're going to send the replay tomorrow. And then Friday, Saturday, and Sunday, you're going to have a mini series that's delivered that has a deep dive into a lot of the stuff we talked about today. All right. So Cheryl is asking, if you bought a rental in your IRA and managed it yourself, but did not pay yourself any type of management fee, would that disqualify your IRA with indirect benefit rule?
Oh my goodness. Great question. Great question. I actually answered a question. They asked if they could be the property manager. And, this is kind of a loaded question because technically speaking, indirect benefit is you making money or utilizing the asset for your benefit. We talked about that when I talked earlier, right? If you stay in that rental property for any considerable amount of time, or you rent it to any of the disqualified individuals, obviously that's going to be an issue. If you take no income from managing the managing the property itself, have you actually received a benefit from it? That's the question, right? If you were paying a property manager, would you be paying the property manager? Outside of you, you'd be paying them, right? Your IRA would have an expense. Your IRA, I do not believe, would have an indirect benefit rule issue if you were taking $0 for managing that property. Now, the rent that's coming in needs to come directly to the IRA. So if it's going to you before it goes to the IRA and you're touching the funds, no, don't do that. And I can assure you over time, when you have multiple properties, that you're probably going to get a property manager in place, and you're going to realize pretty quickly, unless that's what you do for a living, and there might be some of those out there, just be very, very careful, because if you own a property management company and you are audited, they may deem that to be an indirect benefit to you. So don't take any money from it.
And I want to add to that. We audit the subscription paperwork, of course, but we find a lot. And so check it yourself. Make sure you're not doing this. If you're investing in a fund or a syndication, one of the private offerings that you've heard about today, and you're like, cool, I can use my self-directed IRA. The bank account information you give us to pay has to be the bank account for your IRA account. It can't be your personal bank account. And we don't know which is which, right? We just see the number and we send the money every quarter. And so if that money goes to your personal account, you're going to have to sort that out. We can't check that. We can check other things in the paperwork, but we won't know the bank account information if it's your personal or your IRA. So just make sure if you're investing with your IRA and anything you saw today, make sure that all the money you receive from that investment goes back into your IRA's bank account, not to your personal bank account. It will break my heart if you mess up your IRA because you received funds from your investment.
You know what's super important, Sarah, about that, what you just talked about is, when we invest in something, we go to investment sponsors assuming that they understand how you invest through an IRA, but they don't, right? They are looking to figure out how they raise capital, and they don't think about the fact that these IRAs have tax benefits because they're held by a custodian that's governed under IRS rules and regulations. So when you invest with any alternative, you have to make sure that it's vested under the custodian's name. So in this particular scenario, it would be Preferred Trust Company for the benefit of Carrie Cook's Roth IRA. That is tied to the EIN number of the custodian, not your Social Security number. So although that investment sponsor may be getting personal information from you, they have to know that it is not to be taxed to you directly, and all tax documentation goes directly to the custodian. So when you set up that account, you have to make sure that you have the vesting name, they understand who the address is for the custodian, and where all of your subsequent tax documents need to go, because it's not to you. As well as the income. It needs to come back into the IRA, just like Sarah was mentioning.
And when investors invest with us, our investor relations team will help, walk people through the paperwork and all that. But some people elect not to take the help. They elect to, do it on their own and not contact our team, which is totally fine. Then we're not able to double check unless someone says, I'm going to invest with my IRA, and then we see the paperwork's in their name and we're like, we got to clean this up, cancel everything, start over. But make sure, especially the first, second, even probably the third time you're using your IRA to invest, that you ask the sponsor and you ask your custodian to double check that you've done everything right before you start moving money back and forth. Because both can help. And you want to ask both, because also, we don't know everything, obviously, and different custodians and different types of accounts have different nuances. Here's a question. So when I was saying all the money from the investment needs to go back to the IRA and not back to the investor's personal bank account, we have a question. Do you mean a local bank or back to the custodian of the IRA?
Back to the custodian of the IRA. So the custodian does not keep a separate bank account for each client. It doesn't function in that way. The custodian has multiple bank accounts. They may have multiple bank accounts. They separate certain things within those bank accounts, but it is not a bank account that's specifically tied back to the IRA uniquely of that client. So as an alternative custodian, something that's important is we don't aspire to say, send us your cash and let's just sit here with your cash. People are investing in alternatives. So there's very little cash that's actually being held in the accounts. So it comes in and it goes out, but it's coming in and out of the custodial account. The investment sponsors will receive funds from the custodian's bank account, and they will send funds back to the custodian's bank account on your behalf for the benefit of.
Awesome. Thank you. All right. I'm going to run through some other questions. Someone asked, did you say you pay 9% a month in your fund? Nobody said that they're paying 9% a month. That would be the most amazing investment on here. I wish that I found that and sourced that for you guys, but I did not. 9 times 12, that would be a really nice ROI.
That would be amazing.
Yeah. Yeah. So sorry, no, we didn't say that.
Yeah.
I think she was asking on our, so we pay 9% annualized. So we pay monthly, but it's annualized 9%.
Yeah, there you go. All right, Ignite funding. Can you share your default rate?
Yeah. So first, let me kind of quantify that, because defaults in and of themselves are not necessarily a bad thing. If a borrower is late with an interest payment, that's technically a default. But if they get that interest payment into us and we process it with a late fee, that's not a negative situation to our investors. So default in and of itself is not the issue. It's default and foreclosure. So when we're put in a position where we have to actually foreclose on a piece of property, now that's a different animal. And that can take some time because obviously the interest payments stop. The property goes into foreclosure. We have to follow a legal process to actually gain possession of that property. And then once we have possession, we have to market it for sale, get it under contract, and get it sold to return the principal back to our investors. So getting back to the question, our default and foreclosure rate since we opened our doors in 2011 has been less than 3% of all the loans that we do.
Okay, thank you. While we're on you, Howard, there are some questions about location as well. Do you lend in North Carolina and Missouri?
So there's no place that we can't lend.
Okay.
However, we choose to lend primarily in non-judicial foreclosure states because it takes an element of risk out of the equation for our investors. That being said, there are certain borrowers that we do work with who we will lend in judicial foreclosure states because those borrowers have demonstrated to us an ability to build and develop and sell what they're building, and they have a good track record. So I guess the answer to the question is yes, but the yes, with some caveats. So we look very carefully at every investment that we make, where it is, what it is, who's developing it, what is the builder's margins that they expect to realize at the end of the day. Because if a builder is making good margins on what they're building and selling, that provides a very safe and secure environment for our investors.
Thank you. Thank you. All right. Question around taxes and self-directed IRAs. What are the pros and cons of doing these investments in a self-directed IRA? I know you're not a CPA, but Carrie, would you take that?
The pros and cons. Okay, let's just talk cons. I think we all know what the pros are. The pros are tax deferred, tax-free income, and potentially gains on some of our investments. The cons are, from time to time, there are two taxes that could affect your IRA depending upon the types of investments you're investing in your IRA, UBIT and UDFI. If you have a situation where, I'll give an example of rental properties or fix and flips, excuse me. Let the tax code states that if you fix and flip multiple, this is their terminology, multiple, within a 12-month period, they consider that to be you operating a business within your IRA. You are going to have UBIT as an issue in your IRA. Tax at capital gains taxes, big hit to your IRA. So there are certain types of things that could affect your IRA where you would have to file it, what's called a 990T, that's completed by your tax professional, executed by your custodian. So stay away from those types of things. UDFI, when you are leveraging your investments, let's say you want to buy a rental property and you want to utilize 50% of your IRA funds to buy the rental property and 50% in a non-recourse loan, which, by the way, that's the only type of loan you can have associated with your IRA. 50% of it is non-recourse. That means 50% of the income is derived off the premise of if you didn't have that 50%, you wouldn't have 50% of that income. So 50% of that income is taxable because you have leveraged it with debt. So UDFI is kicked off. Those are the two cons. So you want to stay away from investments that demonstrate those two scenarios inside of your IRA. We have some more information about that on our website, getting more granular. But for the most part, most investments that we talked about today are passive income investments. Those do not have the scenario that we're talking about today with UBIT and UDFI. Passive income, no additional tax, runs through your IRA, tax deferred, tax free.
Thank you, Carrie. And Ben, just to double check with you, all of your investments that you mentioned, you can use a self-directed IRA for those, right?
We do, yeah. We actually implement UBIT blockers in a lot of our, real estate opportunities that, block the UBIT at that level. So there are some other tax implications, but generally it's more tax advantageous to invest through those. Yep.
Oh, cool. I've never heard of a UBIT blocker. How does that work?
Yeah, I'll probably give it the high level. Carrie's probably the ninja on this, but the idea is it's a separate C Corp that invests into the fund, and at the C Corp level, it doesn't generate UBIT. And so investors do not get passed through any of the UBIT tax, but they do have to pay C Corp tax. But generally, if you're leveraged above, say 50% on a real estate deal, the break even is around that 50% mark. So if you're leveraged higher than that, then it's actually less tax to pay the C Corp tax versus the UBIT tax.
Okay. All right. Thanks. Good to know. All right. What else do we got? Audience, you've got a screen of experts in front of you. Ask us anything. Someone's asking about what is the ROI for cash flow mortgages? I don't know if someone spoke on that. Ooh, here's one that could be a round table for everyone. Is inflation under control, or will it roar back? Will interest rates go down or continue going up? How can investors protect their investments in case interest rates will go higher? Will your investment funds provide higher ROI to compete with higher interest rates offered by banks and treasury bills? I mean, that's a mouthful. Lots of great questions there. Who wants to take a stab at it?
I could take a stab.
Yeah, I saw you come back on camera. I'm like, oh, she wants this one.
Howard, go ahead. You can go first.
No, you go. I've already spoke.
So
You first and I'll follow you.
Sounds great. That just means I'm setting you up for success.
Okay.
So here's the problem. They've set this unrealistic metric. And at the end of the day, in today's society, with just the sheer growth of our economy as a whole, trying to get to a target of 2% is just not going to happen. It's just not. Think about from perspective, looking at housing is a great example, right? We've got this massive housing shortage. Prices are going to have to continue to climb to offset the lack of inventory for at least the next 8 to 10 years, in my opinion. You can't have an economy that is growing at only a 2% price increase rate when you've got everything else getting more expensive from a home ownership perspective, a rental perspective, cost of goods perspective. It's also, you have to think things are going up in value also because technology is increasing, what is being offered is increasing. 2% is just not a realistic metric. The problem is they doubled down on it, right? We got down to like that 4% range and they said, no, we're still not hitting that metric. That being said, I've got my money parked in a bank right now making 5%, and that's just in a regular bank account. That's what's being paid. So as people that are offering investment products, we have to make sure that we're offering something that is going to exceed what you can get in just some type of regular, safe, liquid investment. The problem when you look at just a bank account is your money is getting more worthless by the day. So when we're talking about real estate specifically, I mean, right now, nationwide, and I hate to use that term, but nationwide, they said today that we are going to hit about 9% up year over year. And that's in what's considered a very down year. So any way you cut or slice it, you're making more on having assets, having things that are cash producing assets, whether it's notes, whether it's lending, whether it's real estate, whatever it is, you should in theory make more. In addition to that, when your money's sitting in a bank, you're not getting the types of tax benefits that you're also going to get when you own that asset that's depreciating. So with real estate, you've got cash flow every month, you've got appreciation, you've got principal pay down, which in cash on cash return on a 30-year mortgage, 20% down, that's another 5% a year return cash on cash that you're getting just for holding an 80% mortgage on that home. So there's actually 4 ways to make money. And that's before you do cost segregation, where that money you're taking now up front, it's worth more now than what it ever would be in the future. So although I think inflation is down, I don't think we're going to hit target, but I don't think with how much interest rates are up and what's being paid on the open market and banking and other very, very safe avenues right now, still pales in comparison to what you can do in the investment world.
Good luck with that, Howard. I think she covered it.
Yeah, she did. That was very in depth, and thank you. It's my elementary study of economics leads me to believe that a consistent inflation rate is probably somewhere around 3.5% to 4%. So I'm kind of in agreement with Leah that we're not going to see inflation get down to 2 or even less. And then something that nobody ever really talks about either is a deflationary cycle where we're not inflating, but we're deflating, and how that can really tank the economy in a worse way than too much inflation. the Federal Reserve has been tasked with the job of keeping inflation at a reasonable rate. And what does that mean, reasonable? I mean, that's different economists will argue that point all day long, but I think that going forward, we can all expect that the dollar will slowly but surely over a long period of time lose value, as it always has, which means that the assets that we hold will go up in value. And so, in my mind, the best hedge against inflation is hard assets like real estate. It's one of my favorite asset classes. But we're also in a technological revolution in this country and around the world where technology is making business enterprises much more efficient than ever before. And so we're seeing these new efficiencies come out in ways that don't really fit the old models. So I think that there is a definite balancing act going on in our economy. And as investors, I think that it's important to cover all the bases. Yes, you want to keep some cash on hand and you want to stay a little bit liquid, but also you want to have some hard assets for the long term, to protect yourself from a devaluing currency. And I go back to my training as a financial advisor that the diversification is the key objective. It's the one thing that'll carry us all through to the finish line, is by being well diversified into different asset classes.
Exactly.
Sarah, can I add just a little bit of nuance to that question? Because I have a similar take, but slightly other things I'd like to point out, if you're okay with that.
Yeah. I was going to say, Ben, I'd love to hear your response to this one.
Yeah, I think, again, what inflation does is probably anyone's guess, but I'm probably more with Leah in that it's going to be difficult for the Fed to tamper inflation down to the 2% mark. Historically, we've been close to that, but I think there's a lot of things that have kind of fundamentally changed. If you look at the kind of two biggest drivers of CPI, which isn't the only measure they use to measure inflation, the ones that have led the growth that we've seen is housing and energy. And we're actually seeing the trend of housing coming down, right? Because we had massive rent growth in 2020, 2021, and even in 2022. And that's really slowed down. There's actually negative rent growth in a lot of markets. And there's about a 12-month lag of the housing data that's being reported to CPI for a variety of reasons. So I do think housing is actually going to be putting less pressure on CPI. But then there's an article today, and I know, Sarah, you and I are both in oil and gas and very bullish on that sector. So a front page of Wall Street Journal, CPI just ticked back up because of higher energy prices in August. And so I actually think energy is going to be another big driver and another big challenge because of pretty massive supply shortages we have in the energy sector as well. They're going to keep putting pressure on inflation. So my personal view is that we're going to see higher inflation for probably the next 18 to 24 months. But the other weird thing is that we actually, like China right now, is potentially having deflation for a lot of different reasons. Some things I mentioned earlier in my presentation with some of their demographic issues. But I think on a long-term basis, we have more risk of deflation than we do inflation. And again, right now, the short term, we have inflation that's going to keep interest rates higher. One of the best hedges of inflation is real estate that appreciates and that can push through the inflation to the end user, whether that be rental real estate, whether it be industrial real estate, storage, et cetera, et cetera. The biggest thing right now that I think is, you said, how do you protect yourself as an investor? This is the number one thing that I tell people, and coming from a banking background, is understanding the debt that is on the asset, because we all like real estate, right? We're all here because we like alternative assets. We're interested in learning about them. But the real big question, the number one question over the next couple of years is, can you hold on to your assets, your real estate, without the bank taking them back if you're investing on the asset side? And so understanding the debt, I think, is really the most important critical factor in evaluating any opportunity right now over the next kind of 3 to 5 year period.
Harry, you want to take any part of this one?
I mean, they've covered it.
They covered everything. Yeah.
Yeah. I mean, there's so many great points in all of that. Here's the one thing I am going to say. And this isn't a preferred trust perspective. Full disclosure, this would be an Ignite funding perspective, is how we treat our borrowers during this period of time is very important. And I think that there's a lot of companies that are looking at increased interest rates and saying, well, surely I've got to follow this train. I've got to increase our interest rates to our borrowers. Our investors are demanding it. Be cautious. Be cautious when you're investing with groups that are following that train right now, because all it's doing is harming the ability for the borrowers to make these interest payments. They're already having difficulty with their exit strategies. So if you're going to hit them up by increasing their interest rates, you better be prepared for increased defaults. And so that's all I'll say on that topic. I think we need to be cautious in that regard as both investors and investment companies that are lending on real estate. We've got to keep all aspects of this strong and not get too greedy.
I heard from a lender, a commercial lender, said this to me: when 5% of our borrowers default, that's okay. Like that's their problem. But when 50% of our clients default, now that's our problem. And so they said they're actually trending towards working more with their borrowers to either extend or change payment schedules, because they're not actually equipped for, like, if there is a mass amount of defaults and foreclosures, they don't actually want that. A little bit is okay, but a lot is a big problem for them. So that's going to be interesting to see how lenders shift if that becomes the reality. And yeah.
One thing I'd like to add is I think that this is one of those times where it's very important to distinguish between commercial lending world, meaning multifamily and everything under the commercial bracket, and single family, because we're in unique times in the single family realm, because homeowners have more equity than they've ever had in history. Almost $100,000 more equity right now than they did going into COVID. The average homeowner has, I want to say, like almost $280,000 equity in a lot of your more expensive areas. And here in North Texas, your average homeowner is sitting between 50 and 70% LTV. So it's very interesting to see how different, because usually when the market crashes, which we've only had one real great recession, right? And that was for a lot of other reasons. What happened in 06, 07, 08, 09 is what led to that. I don't think we'll ever see that again. But at that time, everything suffered. What's unique about what's happening right now, and I think why they're struggling so much to control inflation and really get a grasp on actually what's happening, not only are they manipulating numbers, they're using numbers that are outdated. They're not accurately keeping numbers stable. They're changing them after the fact. There's so much happening right now. And part of it is because they've never really seen this before. This is a very unique time because you've got single family housing unable to kick down. You've got employment at all-time highs, and what little tick-ups there has been in the unemployment rate, it really is artificial because you've got so many people trying to find employees who can't find workers because there's just not enough. And so we're in a really unprecedented charting history right now, and I just don't think they have any idea what to do with it, how to handle it. But from the single family side, I don't think we're going to have any type of mass default, relendability issue, any of that, because people have so much equity. People will just sell if they can't refinance. And that's where we're struggling on the multifamily side. I know a lot of multifamily operators that are trying to liquidate and they can't.
Yeah, definitely. Well, we are at 12:30 Pacific, so we've been on for 3.5 hours. Those who are still on in the audience, you guys are amazing. Speakers, thank you for all being here. Before we go, I want to say one thing, and then I'm going to ask everyone to answer one last question. So again, the replay is going out tomorrow, and then Friday, Saturday, Sunday, a mini series will go out to everyone on here, and it's a deep dive into a lot of concepts, and it'll be workshop style. So bring a friend, bring someone that you co-invest with. It's recorded, so you can bring them just, to your own computer or your cell phone while you watch it. But when I say take out a pen and paper and write it down, really do that. Those are the things, those are the actions that are going to help you change your life and change your trajectory and help you really live your dream life. Because that's why you were here the last 3.5 hours. Was not to just listen to us talk, but to change something in your life, whether it's to bring you more financial freedom, location freedom, time freedom, whatever it is, whatever your reasons for, more cash flow, more wealth for your children or grandchildren. Really get specific and identify how to take those actions. That's why we all spent the last 3.5 hours with you, is we want to make an impact on your life. That's really rewarding for us. And I encourage you to, with the replay, we're going to have information on how to contact all the speakers who are here today. So I really encourage you to reach out to all of us, because we all had unique things to contribute to your journey, and we'd love to be there for you. With that, I would like each speaker to have, if there's a final thought you want to give to folks around preparing their investment portfolio. It's Alternative Asset Summit, but how to choose these confidently. One last word of wisdom. Let's just go around and have everyone give a final comment. We'll start with Carrie.
All right. How to choose wisely. Boy, that's a loaded question. From the perspective of preferred trust, what we find a lot is that individuals are taking the marketing ploys that are being fed to them through social media and believing everything that they see and read, and looking it up online and still believing what they're seeing and what they're reading. And unfortunately, we find ourselves at Preferred Trust finding individuals being taken advantage of because they're not taking the next step. Criminals are smart.
Mm-hmm.
They know how to feed you the right information at the right time in the right place, and they know how to back that up through a bunch of crap online. You have to dig deeper than just what you see, what you hear, and what you read. Talk to the people behind the business. Do the research from the regulatory side. Check with different industry leaders. Find associations, see if they're listed. Like, do a really deep dive on these organizations that you're working with. If they won't pick up the phone and talk to you, there's a reason. So protect yourself as much as you possibly can.
Love it.
I guess I can go
Sarah,
next. Oh, you go ahead, Ben.
Okay, sure. Yeah, I love what you said, Carrie. I would agree. I think it's been interesting. We've been in the space for about 11 years. In the past 3 years, the amount of people that are syndicating raising money seemed like 10x, right? And so everyone and their mom is now raising money and an expert in real estate. And I think there's going to be a big kind of reset in the market because a lot of those deals probably aren't going to make it, especially in multifamily, which was probably what most people were doing. So I think, as a passive investor, who you're investing with is so important, and making sure the track record, there is a track record, and, ideally they've gone through some cycles, or they've at least been around for a while and have seen a lot of things and can, no one knows where we're going, but if you've been through ups and downs, you have a better chance of making it through. And I think with that, just doing the basic due diligence, right? I love what you said, Carol. A lot of people get enamored by the numbers being marketed, right? But not all returns are created equal. And what you need to do is you need to adjust with the risk that you're taking. And that then begs the question of, how do I define risk? There's lots of different types of risks, but learn some of the basic due diligence, right? And then creating diversification. Part of what we love doing is looking at multiple asset classes, understanding that there's cycles in every asset class, and there's good times to be in certain asset classes. There's not as good times to be in. And so understanding some of those basic, cycles and where we're at and what ones are going to hopefully do well and better than others. So those are some just thoughts I had.
Excellent. Yeah. And I couldn't agree more. I think that the last thought I'd like to convey to everybody is to know that matters of personal finance, saving, investing, and preparing for your future, it's not as complicated as it may seem. In a former life, I used to be a golf instructor, and I used to tell my students that, nobody starts off playing golf good. Everybody has to learn. Everybody has to practice. Everybody has to acquire the skills. And I would encourage everybody here to take a little time. I consider myself a continual student. I learn new things every day, from attending presentations to reading stuff online and doing my own research. And you'll be amazed at what you find out there, because yes, there are a lot of scam artists who are trying to take advantage of you, but there are also a lot of good things hiding in the in-between areas where you didn't think about that. And doing your own due diligence, taking the time to learn the concepts and the terminology, it'll be well worth it in the long run, because you'll be able to better structure your own life and your own personal finances in a way that'll get you to your goals in the end.
Yeah, and so I think where my mind goes when we talk about all this is, when you're vetting people, you have to keep in mind, not all these people are scam artists. There are many that are, don't get me wrong. A lot of them are just ill-experienced. Someone doesn't have to be bad to lose you money. At the end of the day, it was really impossible to lose money 2020 to 2022. If you lost money in that period of time, you have no business investing in real estate. And I don't mean that rudely. It's just that the market was incredible. And so if the numbers that they are using for historical to show you what they do for people and what they've done is all 2020 to 2022, which most of what's coming across my desk right now, that's what it is. That's a huge major red flag for me. And then another thing is, are they investing alongside you? I can't tell you how many of these syndicators are not invested in their own deals, and that's a major red flag. I hear them make excuses like, well, it's going to sell out too quick. I've heard so many things in all these that I see, but at the end of the day, if they believe in the product, they should be doing the same model and investing with you. And my final thought for you is, what is resilient? What is what's going to be needed no matter what? Obviously, for me, I've defined that as single family, because people are always going to need a place to live. Even in time of a crazy virus, people are going to want their space. We saw that with COVID, and especially here in North Texas, where people were exiting multifamily, moving into single family. So I've made that decision for my own personal assets and investment strategy of what is resiliency. For you, that might look like something different. That might be CDs in a bank account. So whatever you pick, just make sure you're thinking through, what is the worst that could happen, and is this still going to be a needed thing? And if the answer is yes, then that's a great thing for you to be investing in. And you can always diversify within those resilient assets. Where I would caution you is, stay away from the new shiny gold thing. When everybody was doing Airbnbs and all these short-term rentals, I was out here saying, y'all, they're going to regulate this away. It's decimating the hotel industry. The cities don't want it. Neighborhoods don't want it. This is a short-term gain, and you're going to be stuck with these overpaid houses that you're buying based on valuation of short-term rental income. And lo and behold, what's happened. And so that's not to say that there's not money to be made in Airbnbs. I just made like $1.5 million profit on one that I owned for 1.5 years. You can make money, but that is not your retirement long-term plan. Stay away from the shiny gold, the shiny objects, unless you like gambling, because all of us, we gamble sometimes in our investment strategy, but that is not the strategy we should be bringing to our customers.
A lot of people were talking about due diligence. So know that on Saturday, you will receive a due diligence resource from Sarah at sugocapital.com. So keep an eye on your email, because if you're like, whoa, I need to learn some more about that, we have a pretty thorough resource coming to you. And I'll end by saying, keep an open mind and be really honest with yourself when you're doing your portfolios. So don't invest in something because we said so, or because someone, a neighbor, a family member says so. Really be honest with yourself about what your goals are, because they're different than anyone else's goals. Be honest with yourself and who you co-invest with. Make sure you are aligned, and make sure you set goals that are not just like, hey, I want to retire wealthy, but goals that are really specific. So what year do you want, if you set a goal, what is the date of that goal? Set milestones and the number associated with that goal. I want $5,000 passive income every month. I want $15,000 passive income every month. Get really specific. Or I want my net worth to double in the next 5 years. Whatever it is, write it down, get really specific, put it where you can see it, and keep revisiting it. If you don't get that specific, it's not going to happen. Other things are going to take priority. So me and my husband in the last 3 years, so we write our goals very specifically. In the last 3 years, we 10x'd our net worth. We were not focused on cash flow. We were not focused on income. We were focused on net worth. And because we were so hyper-focused on it, we achieved a really nice goal around that. And so I'm very passionate that people, if you are married, make sure the goals that you're both aligned on those goals and you have a date. And you're so much more likely to get there if you write it down and you write it down with someone else. And think beyond what you've already, keep learning. I know we've said that a lot, but those are my final thoughts. I appreciate everyone who's been here. Speakers, special thank you for spending so much time giving what's in your brain to everyone who's here. I'm sure you helped them immensely to move forward on their investing journey. All right. And that's a wrap. Thank you.
Thanks, Sarah.
Bye.
All right. Bye, everyone.